How much money do you actually need before investing starts working? That's the question, right? People say 10 grand, some say 50, some say don't bother until you've got six figures sitting there. So I went and pulled every number I've run this year. $100 a month at the bottom, $1 million at the top. Everything in between in order so you can find the number you're actually starting from. In this compilation, I've put all of it in order, smallest to biggest. I'll show you how $100 a month, which barely feels like investing, gets to a $330,000 portfolio paying about $1,500 a month. Then $1,000 a month. Then $5,000 as a one-time investment with 3 filters I use to decide whether a fund's worth buying in the first place. There are 2 $10,000 videos in here. One's the projection, the other one's my portfolio, actual money, and you'll see what it pays me each month. I would be sure to watch those 2 together. I'll show you how $100,000 invested in the 3 best growth ETFs is projected to reach $49 million, and how getting that pick wrong costs almost $37 million over 30 years. Or the same $100,000 into REITs, real estate investment trusts, if you'd rather have the monthly $11,000 check for life. We'll cover investing $200,000 across 5 Fidelity funds, $500,000 into 5 ETFs, and one of those is handing over $5,000 a month by year 5. Then $1 million into SCHD. We'll see how fast it doubles, learn the rule that lets you work that out yourself for any amount, and discover how it still pays more than $60,000 a year while it's doing it. All of that starts somewhere much smaller though, $100 a month, 10 years, and a number at the end that doesn't match the effort going in. Nobody looks at a $100 bill and thinks, well, this is going to change my life. That's exactly why it works. In this video, John starts with $100 a month in one of the most popular index funds in the world. I'm going to break down exactly what happens after 1 year, 5 years, and 10 years. Then I'm going to extend the timeline, introduce a second fund, and in the end, I'll show you how the same $100 a month could be paying John over $1,500 a month in dividend income. It all starts with what John has right now. John has $100 a month. That's a phone bill, a few takeout orders, a pair of shoes he'll forget in about 6 months. He's not sitting on a pile of savings. He doesn't have a finance degree. He just knows he should be doing something with his money besides spending it, and $100 a month is what he can start with. The question isn't whether $100 is enough. The question is what happens when he stops spending it and starts putting it somewhere that grows. That somewhere is the part that trips people up, because the answer is simpler than they think. When John hears investing, he pictures picking stocks, finding the next Tesla, and watching charts all day. That's not what this is. An ETF, an exchange-traded fund, is one purchase that buys you a piece of hundreds of companies all at once. Instead of guessing which company's going to win, John buys a basket that holds all of them. If one company has a bad year, the others carry the weight. He doesn't need to research earnings reports. He doesn't need to watch the market every morning. He buys one fund once a month, and the basket does the rest. This is what makes an ETF the starting point for someone like John. Not because it's exciting, but because it's simple enough to actually stick with. Before John picks his fund, there's one thing you need to see first, because this is the main reason why $100 a month works. It's called compounding. Let me explain with an example. Say you invest $100 one time into a stock trading at $5 a share. That gets you 20 shares. Now say that stock pays a $5 dividend yield, which means it pays you $5 a year just for holding it. Not much. But you don't spend that $5. You use it instead to buy one more share of the same stock. After year 1, you own 21 shares worth $105. The dividend is no longer on 100, it's on 105. So year 2, it pays you $5.25. That buys you another share and a fraction. Now you have 22 shares worth about $110. Year 3, the dividend is 5.51. You reinvest again, 23 shares, $115.76. You never added a single dollar. The money made its own money, and then that money started making even more. And here's the part that matters. This example assumes the share price stayed flat at $5 the entire time. It didn't grow at all. If the share price grows on top of the dividends, that's a second layer of compounding working at the same time. What you just saw was only one layer. Now scale that up. John's not investing $100 one time. He's adding $100 every single month. Every $100 he puts in joins a machine that's already running. The first 100 has been compounding for months by the time the 5th 100 shows up. And by the time the 50th shows up, the first one has been growing for over 4 years. That's why the starting amount doesn't matter as much as people think. What matters is that John keeps showing up. So where does John put that $100 a month? The most common answer in the world is an S&P 500 index fund, and there's a reason for that. The Vanguard S&P 500 ETF, ticker VOO. It tracks the 500 largest companies in America: Apple, Microsoft, Amazon, Johnson & Johnson, all of them in one fund. John doesn't need to pick which one is going to win. He owns a piece of all of them. Now, VOO charges an expense ratio of 0.03%. That means for every $10,000 John invests, he pays $3 a year in fees. That's as close to free as it gets. The fund blends out to a 1.14% dividend yield, a 6.07% dividend growth rate, and an average annual share price appreciation of 12.7%. And that appreciation rate is what's going to do most of the work over the next 10 years. So what happens when John puts his $100 a month into this fund and doesn't touch it for a decade? That's what I'm going to show you next. And later in this video, I'm going to introduce a second fund that turns the same $100 a month into over $1,575 a month in dividend income. But first, here's what the projections show. After 1 year, John would have put in $1,200. This sets the stage for future growth. After 5 years, he would have contributed $6,000. His account is projected at $7,875, almost $2,000 that he never deposited. That's the compounding that we talked about in the $5 example, except now it's running on 5 years of monthly contributions. After 10 years, John would have put in $12,000. His account would grow to $22,606. The fund would have added over $10,000 on its own. He doubles his money without doubling his effort. That is what 10 years of consistency looks like inside an S&P 500 index fund. But what if John continues? Well, here's what happens when John keeps going after 10. The title of this video is 10 years. John got his answer, but the $100 a month is already automatic. It costs him nothing extra to just leave it running. After 20 years, John would have contributed $24,000. His account is projected at $99,816, just $200 away from six figures on $100 a month. After 30 years, the contributions would total $36,000. His account would grow to $358,324. The fund would have added $322,000 that John never earned at a job. And that's not a different strategy. That's the same $100 a month with 20 more years of compounding behind it. But John checks something else. He looks at how much VOO is paying him in dividends. After 30 years, on $358,000, the fund is projected to pay him $41 a month. $41 on $358,000. The account grew, but the income did not. And that's not a flaw in VOO. Income just isn't what VOO was built to do. But there is a fund that's built for income. This is the Schwab U.S. Dividend Equity ETF, ticker SCHD. It doesn't try to compete with VOO on growth. It holds around 100 companies selected for one thing: paying dividends consistently and growing those dividends over time. The fund blends out to a 3.41% dividend yield, a 10.43% dividend growth rate, and an average annual share price appreciation of 8.59%. The appreciation is lower than VOO, about 4 percentage points lower, but the dividend yield is 3 times higher, and the dividend growth rate is nearly double. That's the trade. SCHD grows your account using dividend compounding, and it pays you while it does it. John runs the same setup, $100 a month, same schedule, same discipline. After 10 years, SCHD is projected at $21,472. That's about $1,100 less than VOO at the same point. If John stopped there, VOO wins, no question. After 20 years, SCHD is projected at $95,414. VOO is still ahead, but the gap is shrinking. After 30 years, SCHD would grow to $374,764. VOO is at $358,000. SCHD passed it. And the dividends, $18,898 a year. That's $1,575 a month from the same $100 a month that John would have been investing the entire time. VOO built the bigger account for 2 decades and ended up behind. SCHD spent 20 years losing the race and then won it while paying John more per month than some people earn in a week. Neither fund is wrong. VOO is for the investor who wants growth and plans to sell shares later. SCHD is for the investor who wants the account to pay them without selling anything. Same $100, same 30 years. 2 completely different outcomes. If you had $1,000 a month to invest, you'd want the best index funds, right? Then you'd probably spend a weekend arguing about which 3. In this video, John is settling the which 3 argument. One fund to anchor it, one to chase growth, and one almost everybody says to leave out. I'll show you what each fund is, what it holds, and why it makes the cut. And by the end, I'll show you how all 3 together are projected to turn John's $1,000 a month into $4.3 million. So here's the plan. John's not dropping his $1,000 into one fund and hoping. He's splitting it across 3, and each one's got a different job. The first is the anchor. Boring, cheap, the thing everything else is built around. The second is the growth fund, the one swinging for the big returns. And the third is the one every best of list skips. 3 funds, 3 jobs. Get the anchor right first because it's the one the other 2 lean on. Fund 1, FXAIX. Look, nobody starts investing dreaming about the S&P 500. It's the plain oatmeal of index funds, but that's kind of the point. FXAIX is Fidelity's S&P 500 fund, so when John buys it, he's buying a slice of the 500 biggest companies in America. Apple, Microsoft, Nvidia, all of them in one shot. And it's almost free to own. The expense ratio is 0.02%, which comes out to about 20 cents a year for every $1,000 invested. You'll spend more on one coffee than on an entire year of holding this. The numbers are about what you'd expect from something this steady. FXAIX pays a dividend yield right around 1.04%, and it's grown that payout close to 6.84% a year over the last decade. But the number that carries the fund is the share price, historically climbing about 13.39% a year, and that's what does the real compounding. Now, here's something most people don't realize about index funds. That 500 companies makes it sound evenly spread out, but it's actually more top-heavy than you think. About 39% of the whole fund sits in just its 10 biggest names. and nearly the same share rides on tech alone. So FXAIX moves with the giants a lot more than the 500 stocks label suggests. When they have a big year, it flies. And that's not a knock on it. This is still the cheapest, steadiest core money can buy, the foundation you build everything else on top of. It does one job, and it does it about as well as anything out there. But an anchor can really only do so much. It keeps you steady, but it doesn't make you rich in a hurry. For that, John needs something with a lot more fire. Fund 2, FNCMX. This one looks like the obvious upgrade. If the S&P gives you the 500 biggest companies, FNCMX, Fidelity's NASDAQ composite fund, hands John a few thousand. More companies heavier on tech, built to move fast. On paper, it's the S&P with the brakes off. And for years, it sat right at the top of the performance charts, the fund everyone points to when they want to show off a return. The number behind that reputation is the share price. FNCMX has climbed around 17.94% a year historically, comfortably the fastest of the three. The trade-off shows up in the income. It yields about just 0.45%, less than half the anchor, with dividend growth around 6.91%. You don't buy this one for the payout. You buy it for the climb. There's one thing worth understanding about how it gets that climb. For all those thousands of companies, more than half the fund, around 58%, sits in its 10 biggest names. And a lot of those names are the same giants the S&P already leans on. That's not a flaw. It's why it grows this fast. It's the market's biggest winners, concentrated. The fee reflects the extra reach, too, at 0.29%, nearly 15 times the anchors. Real quick, before we talk about the last fund, I use Seeking Alpha for basically all my stock research. And everything you've watched me pull up so far, the holdings, the yields, the growth rates, all of it came from there. And it's today's sponsor. Their alpha picks are the standout, 2 quant-rated stock picks a month, and they've beaten the S&P 500 by over 320%. They also just put out their top stocks report for the second half of 2026. It dropped July 14th. Quant-backed picks built around growth and the long game. It's their flagship for stock picking, available to members only. So if you want in on that, use my links down in the video description or the pinned comment, and you'll get 10% off alpha picks. If you want the premium or the bundle, both discounted links are in the description. Okay, back to John, because that overlap I showed you, the anchor and the growth fund owning the same names, it points straight at the piece John is still missing. One more fund that owns what those two don't. And remember, in the end, I'm going to show you how a portfolio of these 3 funds is projected to reach a $4.3 million valuation. But first, Fund 3, VTIAX, a completely different corner of the planet where everything you just learned about concentration flips on its head. VTIAX is Vanguard's total international fund. Where the growth fund crammed your money into 10 American giants, this one does the opposite. It holds around 8,800 companies from outside the US, Europe, Asia, emerging markets, basically the whole rest of the world in a single fund. How spread out is it? Its single biggest holding, a chip company out of Taiwan, is only about 4% of the fund. The top 10 together barely clear 15%. Nothing in here can sink you on its own. And the numbers flip everything you just saw. On a growth chart, this fund looks asleep. Share prices have only risen about 6.72% a year, less than half the growth fund's pace. But it pays the most while you wait, with a yield around 2.53%, more than double the anchor and roughly 5 times the growth fund. That's exactly why people leave it out, and exactly why that's a mistake. Because this is the only fund really diversifying John. It owns names the other two never touch. It's the one doing the job John originally thought all three were doing. Okay, so now John has his three. The only question left is how much of each? Well, John wants growth, but he's just watched what happens if he leans too hard on it, everything piled onto the same 10 stocks. So an even split is out, and so is investing it all into the exciting one. Therefore, the anchor gets the biggest share, 45%, $450 a month, straight into the S&P 500, because that's the part holding everything else steady. The growth engine takes 35%, $350 chasing the upside, enough to matter without betting the whole thing on it. And the rest, that last $200 a month, goes international, which sounds small, and it's meant to. It's enough to count on when the US cools off, but not so much that it drags on him for 20 years while he waits. Put all three together and the blended portfolio comes out to about a 1.13% yield and 13.65% average annual appreciation, with the dividend growing near 6.8% a year. That appreciation number is the whole ballgame. It's what compounds. The yield's just a little cushion on the side. So now, let's see what this portfolio is projected to do. $1,000 a month across those three funds, simply left alone to run. Start with year one. The projections show John's account at around $12,000, right about what he'll have paid in. 12 months of contributions. By year 10, the projections show the account at roughly $236,000. He'll have put in $120,000 of that himself. So at that point, about half of what he's holding is still just his own contributions. But by year 20, it changes character completely. The projection lands at just over $1.1 million, and only $240,000 of that is money he'll have paid in. The other $870,000 or so is what the market is projected to add. The compounding finally outgrows him. And by year 30, the portfolio is projected to reach $4.3 million. Of that, John will have paid in $360,000. The rest, nearly $3.95 million, is what the market is projected to add. Now, $4.3 million is a ridiculous number, but it's worth seeing what kind of $4.3 million it's projected to be, because it says everything about what these three funds actually are. Almost all of that growth is projected to come from share prices climbing, around $3.88 million of it. The dividends, reinvested the entire way, are projected to add only about $68,000. So by year 30, the portfolio is projected to generate roughly $5,433 a year in income, which is about $453 a month. That's not a flaw. It's the whole personality of this portfolio. John built a growth machine. Three funds pointed almost entirely at getting bigger, not at paying him along the way. And it's projected to get enormous. If you've heard everyone tell you to put money in index funds and thought, okay, great, but which ones? This video's for you. Maybe you've asked yourself, where do I start? Is $5,000 too small? Too late? What if I pick the wrong one and it underperforms? What if the experts are wrong and the next decade looks nothing like the last one? In this video, I'll answer every single one of those questions, step by step. What an index fund actually is, how to pick one without guessing, how John builds a real portfolio with $5,000, exactly how to buy it today, and in the end, I'll show you two things. How John turns that $5,000 into more than $262,000 with 3 Fidelity index funds and 0 contributions after day one, and 2, a more aggressive version where a simple change to that same portfolio pushes the same $5,000 past $733,000. But before John builds anything, he needs to understand where his money's actually going to live, because every dollar in a brokerage account ends up in one of 3 places: a stock, an ETF, or a mutual fund. And the difference between them matters more than most beginners realize. Look, a stock is ownership in one company. That's it. So if John buys Boeing, and Boeing has a brutal few years, which it did right through the 2020 pandemic, he feels every drop of it. One company, his entire investment riding on whether that company has a good decade. Obviously, the upside is bigger if he picks right. The downside is just as steep if he doesn't. Most people don't pick right consistently, and the ones who do, most of them actually got lucky. Now, an ETF is different. ETF stands for Exchange Traded Fund. It's a basket of stocks bundled into one purchase. Hundreds, sometimes thousands of companies inside a single ticker. John buys one share of an ETF and he basically owns a slice of every company inside of it. If one of them has a terrible year, well, the rest can carry it. And nobody's managing the basket. It just tracks an index. Whatever the index does, the ETF does. And that simplicity shows up in the overall cost. ETFs typically charge between 0.03% and 0.3% per year. Now here's the thing, a mutual fund is also a basket. Same idea as an ETF. The difference is how John buys it. ETFs trade on the stock market like a stock would all day long. Mutual funds, however, settle once a day at the end-of-day price, bought directly from the fund company. And mutual funds come in two flavors. There's actively managed mutual funds, where somebody's picking the stocks and charging John roughly 0.5% to 1.5% a year for the privilege. And index mutual funds, which are different. Same idea as an ETF, just a different shape. No manager, no stock picking, it just tracks an index and the lower cost reflects that. Some of the index mutual funds in this video actually charge basically zero. Okay, so where does John land with all of this? Well, he's not going to pick single stocks. There's too much risk on too few companies. He's also not going to pick actively managed mutual funds either. He's picking index mutual funds, same engine as the ETFs he could buy. All things considered, that's so much easier to operate as a beginner. Now, there's one cost number, the expense ratio, that John checks first before buying any fund. Every fund in this video has an expense ratio under 0.3%, with one exception that earns its place, which we'll talk about later on. The expense ratio is the first filter John uses. And there are two more things John checks before putting a single dollar in. They're just as important. The second is what the fund actually tracks. Two funds can both call themselves index funds and own completely different things. One might hold the 500 biggest U.S. companies. Another might hold 3,000. Another might concentrate entirely on a single sector. The third thing John looks at is the minimum investment. This is where mutual funds get tricky in a way ETFs never do. Some mutual funds gate their best share classes behind real money. Vanguard's Admiral shares, for example, the cheapest version of every Vanguard fund, requires a $3,000 minimum per fund. That means a 3-fund Vanguard portfolio is locked behind $9,000. For a beginner with only $5,000, that's an entire fund family John can't touch. Fidelity's index funds work differently. Zero minimum on every fund in this video. So whether John has $50 or $50,000, the door is open to him. So now we have three filters: expense ratios less than 0.3%. We know what the fund tracks. No minimum standing between John and the fund. Every fund in the portfolio clears all three. So let's get into the build. This starter portfolio is built around 3 index funds, each one chosen deliberately, each one with a specific job inside the portfolio. Before we get to how John split his $5,000 across them, let's talk about what each fund actually is and why it belongs here. The first fund holds 500 companies. That is FXAIX, the Fidelity 500 Index Fund. It tracks the S&P 500, an index of the 500 largest publicly traded companies in the United States: Apple, Microsoft, Nvidia, Amazon, Berkshire Hathaway, and 495 others. When John buys FXAIX, he owns a slice of all of them at once. The index is weighted by market capitalization, so when the biggest companies grow, the fund grows with them. And when a smaller company in the index has a rough year, it barely moves the needle because it's such a tiny piece of the total. Expense ratio, 0.02%, basically free. Dividend yield, 1.06%. Average annual share price appreciation, 13.57%. FXAIX clears every filter without breaking a sweat. The lowest cost in the video, the most trusted index in the world, holdings that have survived the dot-com crash, the 2008 financial crisis, and the 2020 pandemic, and recovered from every single one. FXAIX's job in this portfolio is stability. It's the part of the portfolio John doesn't have to think about at all. The second fund is FNCMX, the Fidelity NASDAQ Composite Index Fund. FNCMX tracks the NASDAQ Composite, which is roughly 3,000 companies heavily weighted toward technology and growth. Apple, Microsoft, Nvidia, Amazon, Alphabet, all sitting near the top. Technology makes up half the fund. Consumer and communication services fill in the rest. The difference between FNCMX and FXAIX is concentration. The S&P 500 spreads across every sector: financials, healthcare, energy, utilities, technology, you name it. Meanwhile, the NASDAQ Composite leans hard into companies building the future. And historically, that concentration is exactly why the NASDAQ has outpaced the S&P 500 over long time frames. That said, it's also why it drops harder when technology has a bad year. Expense ratio, 0.29%, higher than FXAIX, and on the higher end of the 0.3% filter. It's worth the trade, though, for what it adds to the portfolio. Dividend yield, 0.46%. Average annual share price appreciation, 18.25%, the highest of the three starter funds. FNCMX's job in this portfolio is simple: growth. It's what pushes John's long-term number past what the S&P 500 alone delivers. Okay, so most beginner portfolios stop at America. John's doesn't. The third fund is FTIHX, the Fidelity Total International Index Fund. FTIHX tracks more than 5,000 companies outside the United States, across developed and emerging markets: Germany, Japan, South Korea, the United Kingdom, India, Brazil, Switzerland, every meaningful economy outside America bundled into a single fund. International stocks don't always move in the same direction as U.S. stocks. When American markets struggle, and they will in cycles, international markets sometimes hold steady or grow independently. That's geographic diversification. John's portfolio isn't tied entirely to America having a good decade, and in a 30-year window, there will almost certainly be stretches where America is not performing well. Expense ratio, 0.06%. Dividend yield, 2.52%, the highest in the portfolio. Average annual share price appreciation, 6.07%, the lowest. FTIHX isn't the growth engine. At a small allocation, it won't drag the overall return, but it covers something neither of the other two can: the rest of the world at basically no cost. Listen, the U.S. market has led the world for the past decade, but it won't always. FTIHX makes sure John is covered either way. So FTIHX's job in this portfolio is balance. So there you have it, 3 funds, 3 jobs. Here's how John splits his $5,000 across them. Half goes into FXAIX, $2,500, because that's where the stability lives. The other 2 funds can take more risk, because this one doesn't have to. FNCMX gets 30%, $1,500, enough to meaningfully push the long-term return above what FXAIX alone delivers without making the whole portfolio rise and fall with the NASDAQ every quarter. And FTIHX gets the remaining 20%, $1,000. Not a token allocation, a real position that adds geographic coverage without diluting the growth story that FXAIX and FNCMX are building together. John's total investment is $5,000, one time, nothing added after day one. Across the three funds, the starter portfolio blends out to a 1.17% dividend yield, an 8.89% dividend growth rate, and an average annual share price appreciation of 13.47%. And that last number is what does the heavy lifting over 30 years. Now, in a couple of minutes, I'll show you how this starter portfolio grows to over $262,000 from John's one-time $5,000 deposit. Then, I'll show you a more aggressive version where a simple change pushes that same $5,000 past $733,000. But first, let's actually get John's money into the market. John has a plan for his portfolio, but now he needs to actually buy it. And here's where most beginners get stuck. Not on the steps are easy, they get stuck on hitting the button. Because picking the funds is one thing, actually moving the money is another. So let's get John through it quickly. 3 steps, that's all it takes. The first step is opening a brokerage account. This is where John's funds will live. Think of it like a bank account, but instead of holding cash, it holds investments. For everything in this video, John needs a Fidelity account specifically because every fund here is a Fidelity index fund. Free to open, no account minimums, no monthly fees, and the process takes about 10 minutes online. Name, address, social security number, and bank account to link. That's everything required. The second step is funding the account. John transfers $5,000 from his bank account into his new brokerage account. Most brokerages process the transfer in 1 to 3 business days. The money doesn't need to be invested immediately, it sits as cash until John is ready to buy. Quick note, one thing worth doing before buying anything, turn on automatic dividend reinvestment. It's usually a single toggle in account settings. When dividends are paid out, and every fund in this portfolio pays them, instead of sitting as cash, they automatically buy more shares, which is free compounding that starts with the first dividend John receives and never stops so long as John keeps reinvesting. Turn it on once and forget it. The third step is buying the funds. John searches the ticker, FXAIX, FNCMX, FTIHX. Then he types in the dollar amount, $2,500 of FXAIX, $1,500 of FNCMX, $1,000 of FTIHX. Confirms the order, done. The fund settles at the end of day price. That's the entire buying process. No special knowledge, no financial advisor sitting across a desk. If you and John can order something online, you both can easily buy an index fund. It's that simple. Okay, so the money's in the funds. Now what? This is where most people sabotage themselves without ever realizing it. John's brain is going to want to do something. It's going to want to check the account before bed, read every news headline about the market, move money around when one fund is up and another is down. That itch to manage the portfolio is the single biggest reason most beginners underperform the funds they're invested in. So here's John's plan for the next 30 years. He doesn't manage anything. There are 3 strict rules he's going to live by so he can maximize his investment. Rule 1, when the portfolio drops, John doesn't touch it. The market is gonna fall. Not someday, repeatedly. Bad year here, recession there. A 20% or 30% drop is normal. It happens roughly every decade. The people who actually lost money in those years weren't the ones who got unlucky, they were the ones who panicked and sold near the bottom. John doesn't sell. He waits. The market has recovered from every drop in its history, and he has 30 years. Rule 2, the dividends keep buying more shares automatically. John already turned this on before his first purchase, so every time FXAIX, FNCMX, and FTIHX pay him dividends, which they do every quarter, that cash doesn't just sit there. It buys more shares of each fund. The more shares he owns, the more dividends he collects next time. The more dividends he collects, the more shares he buys. That snowball runs in the background for 30 years without him doing a single thing. Rule 3, once a year, John takes a look at the portfolio. Not weekly, not monthly, once a year. He opens his Fidelity app, sees what each fund is doing inside the portfolio, and checks one thing. Has anything drifted too far from where it started? Maybe FNCMX had a huge year and now it's 42% of the portfolio instead of 30%? If yes, John rebalances to the original plan, sells a slice of what's gotten too big, buys a slice of what's gotten too small, and puts the allocation back to where it was supposed to be. If nothing's really shifted, John just closes the app and gets on with his life. That's it. One annual check, one rebalance if needed, otherwise, hands off. Now, here's what future projections look like when John follows these steps. John put $5,000 in on day one and never added another dollar. Everything you're about to see is just that single $5,000 doing its work. Year 1, the portfolio is projected to sit at around $5,732. He's up $732. And to a lot of beginners, that feels underwhelming. Here's the thing, year 1 always looks small. Compounding hasn't had time to do anything yet. What matters in year 1 isn't the number. It's that the clock has started. Year 10, the account would grow to roughly $19,241. John still hasn't touched it, and the original $5,000 is now closing in on $20,000, almost 4 times where it started. This is when compounding starts pulling its weight. Year 20, the portfolio is projected to reach about $71,757. John's in the middle of his career now, probably barely thinking about that one deposit he made 20 years ago. But that one deposit is now sitting at over $70,000. And here's the part that sneaks up on people. The same $5,000 took 10 years to become $19,241. The next 10 years? It became $71,757. So decade 2 added roughly $52,000, almost 4 times what the first decade added. The growth keeps getting bigger every decade. Finally, at year 30, the projections show $262,409, over $250,000 from a $5,000 deposit. Of that $262,409, John only contributed $5,000. The other $257,409 came from the market. Most of that, $249,467,000, is straight capital appreciation. The portfolio grew because the companies inside it grew. The remaining $7,942 came from reinvested dividends, the drip toggle John flipped on before he bought his first share. Now, what if John doesn't want safe? What if $250,000 over 30 years sounds fine, but it's not exciting enough? Okay, John, then we change one thing in the portfolio, just one, and the year 30 number stops looking like $262,000 and starts looking like something a lot bigger. This is what I call the aggressive growth version. It's the same $5,000, same one-time deposit, same 30 years, one different fund in the mix. And the math gets dramatic. But before we get into it, honesty check here. Let's get real. This version isn't for everyone. It's for someone who actually has 30 years to wait, and more importantly, someone who isn't going to panic sell when the portfolio drops 30 or 40% in a single year, because it will. That's the deal. If John can't handle a bad year without touching the account, he should opt with the starter. The starter already has his answer. But if he can stomach the ups and downs, all right, here's the swap. FTIHX is out. FSELX takes its place. Fidelity Select Semiconductors portfolio. And before John gets excited and clicks buy, we need to have a real conversation about this fund because FSELX breaks two of the three rules John used earlier in this video to pick funds. Rule 1 was expense ratios under 0.3%. Well, FSELX charges 0.6%. That's more than 2 times higher than the cutoff John set for himself. Rule 2 was tracking an index, not having managed funds. FSELX, however, has a manager, an actual person making picks inside the fund. So fair question, why is John even considering this one? Because of what it actually owns. FSELX invests in one industry and one industry only. Semiconductors, the chips that go into every phone, every car, every server, every piece of AI infrastructure being built right now. Around 60 companies, that's it. The companies designing the chips, manufacturing the chips, and building the machines that make the chips possible. And there isn't another fund at this dollar level that gives John focused exposure to that industry. Most semiconductor-focused funds either require huge minimums to get into them, or they don't exist as a mutual fund at all. FSELX is the path a $5,000 beginner can actually take. The numbers tell the rest of the story. The expense ratio we just covered, 0.6%. Dividend yield, 0%. Huh? Chip companies don't pay out. They reinvest everything back into research. Average annual share price appreciation, 24.5%. That's the highest appreciation rate of any fund in this entire video by a wide margin. Now for the part nobody wants to hear. FSELX falls harder than anything else here when the chip cycle retracts. In 2022, it lost about 35% of its value in a single year. In 2008, it lost nearly 50%. Those years happened. They will happen again. And the only investors who came out ahead were the ones who didn't sell when the screen turned red. Remember that. So that's FSELX, the highest growth fund in the video, paired with the highest volatility ride. Built for one job in this portfolio, aggressive growth, concentrated, risky, and worth it if John can stomach the dips. With FSELX in the mix, the allocation shifts. FXAIX drops slightly to 40% now instead of 50%. That's $2,000 going into the S&P 500, still the anchor of the portfolio. We're just leaving more room for the growth side. FNCMX moves up a bit, 35% instead of 30%. That's $1,750 into the NASDAQ composite, more growth tilt across the broader tech and innovation space. FSELX takes 25%, our new 25% slot. That's $1,250 going into pure semiconductor concentration. Blend the three together and the portfolio comes out to a 0.59% dividend yield, a 5.15% dividend growth rate, and an average annual share price appreciation of 17.94%. That last number is the reason why the year 30 number is about to look very different compared to our starter portfolio. Here's what the portfolio could look like over the long run. Year 1 is projected to come in at $5,927, a slightly stronger start than the starter portfolio. The higher blended appreciation is already pulling ahead in the first 12 months. By year 10, the account would grow to $26,805, while the starter portfolio at the same time was projected to reach $19,241. That's a $7,564 difference from the same $5,000 inside the first decade, and the gap only widens from here. Year 20 is projected to hit $140,623, nearly double what the starter portfolio produces at the same point. 2 decades of concentrated growth and semiconductor exposure compounding, and the distance between the two portfolios is now impossible to ignore. Then year 30 lands at $733,648. Starter portfolio, $262,409. Again, the aggressive growth portfolio, $733,648. The gap between them is $471,239 from the same $5,000, same person, same one decision, same 30 years. But the numbers don't show what John has to live through to get there. This portfolio drops hard. Some years, FSELX falls 30, 40, or even 50% and pulls the whole portfolio down with it. The $733,648 at year 30 assumes John holds through every one of those drops without selling. Every single one. What happens when you take $10,000 and put it across the 3 best Fidelity index funds? John had the same question, and it depends on how the portfolio gets built. One way, John ends up getting paid $2,000 every single month for life. The other way, same $10,000, same 3 funds, that account grows into nearly $700,000. In this video, John takes $10,000 and invests it across the 3 best Fidelity index funds the platform has to offer. One for dividends, one for growth, and one for international exposure. Then he builds 2 completely different portfolios out of those same 3 funds. One tilted for income, one tilted for growth. And by the end, I'll show you how one portfolio pays him $2,000 a month for life, and how the other one turns the same $10,000 into a $700,000 portfolio. So here's where John starts. He looked at every index fund Fidelity offers, and he keeps coming back to the same 3. One for income, one for growth, one for everything outside the United States. Every portfolio worth building needs all 3 of those jobs handled, and these are the funds that handle those jobs the best. A quick note before we get into them, a Fidelity index fund is just a basket of stocks that follows a set rule. There's no manager picking and choosing winners. The fund just owns whatever's in the index it tracks. That's why the fees are so low and why these funds work so well over long periods. Now let's look at those 3 funds. The first fund is FDVV, the Fidelity High Dividend ETF. This is the one built to pay John. It tracks large and mid-cap U.S. companies that pay high dividends and are expected to keep growing those dividends over time. The top holdings are names you already know: NVIDIA, Apple, Microsoft, Broadcom. And if you're thinking those aren't dividend stocks, that's a fair reaction. Most people picture dividend funds as boring utilities and old-school energy companies. But here's what's happening. These tech giants got so big that even a small percentage of their profits comes out to massive dividend payouts. Apple alone paid out over $15 billion in dividends last year. So FDVV isn't just chasing yield from sleepy companies, it's holding the biggest, most profitable businesses in the world, and at the moment, those businesses are starting to pay real income back to shareholders. Now a quick note on what a dividend actually is. A dividend is a piece of a company's profits that gets paid back to shareholders, usually every 3 months. The more shares you own, the bigger the check. That's the whole game. FDVV runs at a 2.8% dividend yield with a 5-year dividend growth rate of 10.85% and an annual share price appreciation of 9.16%. And that combination is what makes it the income engine of John's portfolio. So that's job number 1 handled, income covered. Now John needs growth. The second fund is FNCMX, the Fidelity Nasdaq Composite Index Fund. This is the one built to grow the account as fast as possible. It tracks the entire NASDAQ composite, around 3,000 companies heavily weighted toward technology and innovation. And quick context here, because this trips a lot of people up. The NASDAQ isn't a fund or a company, it's a stock exchange. Most of the big tech companies in the world list their stock on it, which is why a fund that tracks the NASDAQ ends up so tech-heavy. The top holdings are Apple, Microsoft, Nvidia, Amazon, Meta. Same names as FDVV in some cases, but at very different weights. FDVV picks them for their dividends. FNCMX picks them for their growth, which you can see from the tech holdings percentage sitting around 50%. The numbers clearly tell that story. FNCMX runs at only a 0.48% dividend yield, a 6.91% dividend growth rate, but has a 17.45% annual share price appreciation. And that 17.45% is the highest of any of the three funds in this video. So now, John has income and growth. But everything in the portfolio so far is American. A good portfolio also needs global diversification. The third fund is FTIHX, the Fidelity Total International Index Fund. This is the one that gives John exposure to everything outside the United States. It tracks over 5,000 stocks across developed and emerging markets, basically the entire world that isn't America. Quick context. Developed markets are countries like Japan, the UK, Germany. Emerging markets are countries like India, China, Brazil, economies that are still growing into their full size. The top holdings here aren't household names for most American viewers. Companies like Taiwan Semiconductor, Nestle, Novo Nordisk, ASML. And honestly, John almost skipped this one. International stocks have underperformed U.S. stocks for over a decade. So why would he buy something that's been losing the comparison? Simple. Because every portfolio needs something that doesn't depend on America. If the U.S. has had a bad decade, this is the fund that holds the floor. And there's something else about FTIHX that doesn't show up at first glance. FTIHX runs at a 2.54% dividend yield, a 6.2% annual share price appreciation, and a 5-year dividend growth rate of 16.98%. And that 16.98% is higher than either of the other two funds. The international fund that nobody talks about has the fastest growing dividend of the three. So now we have our portfolio: income, growth, and rest of the world. But here's the part most people miss. Picking the funds isn't actually the entire decision. One of the most important aspects of John's decision is how much weight he gives each fund. Because these same three funds can be built two completely different ways. Tilt the weights in one direction, and the portfolio pays him every month. Tilt them the other direction, and the account grows into something much bigger. Same $10,000, same three funds, the weights he gives each fund is the strategy. Next, I'll walk you through the dividend-tilted portfolio, the version that pays John $2,000 every single month for life. And in the end, you'll see how the growth-tilted version takes that same $10,000 and turns it into a $700,000 portfolio. But first, let's see how John builds the portfolio that pays him. This is the dividend-tilted portfolio, and the weights look like this. 50% goes into FTIHX, the international fund. 30% goes into FDVV, the dividend fund, and 20% goes into FNCMX, the growth fund. Now, if your first reaction is, wait a minute, why is the international fund the biggest slice of an income portfolio? That's a fair question. Here's the answer. FTIHX has the highest dividend growth rate of the three at 16.98%. Over time, that is the engine that compounds the income the fastest. FDVV gets 30% because that's where the immediate yield comes from, the cash hitting John's account today. And FNCMX is only at 20% because this portfolio isn't built to quickly grow the account. It's built to pay him. In this scenario, FNCMX becomes the small growth anchor that keeps the account from stalling. And here's the part that flips the framing. Even with 50% in international, the U.S. side of the portfolio still adds up to 50%, FDVV plus FNCMX. So this isn't John abandoning America, it's John splitting the portfolio evenly between the U.S. and everywhere else, while allowing the international fund to do the heavy dividend lifting. When you put those three weights together, the dividend-tilted portfolio comes out to a 2.2% blended yield, a 13.13% blended dividend growth rate, with 9.14% annual appreciation. Quick note on what blended means. It's just the average of the three funds once you factor in how much each one John actually owns. Here's how that portfolio is projected to play out for John. After year one, the $10,000 would be worth $11,134. Modest, nothing dramatic. After 10 years, projections show it growing to $30,453. After 20 years, $103,773. And by year 30, the portfolio is projected to reach $416,613. But the account size isn't actually the headline here. The headline is what that account would be paying him. In year 30, the dividend-tilted portfolio is projected to pay $2,048 every single month for the rest of his life. That's $24,577 a year hitting John's account whether the market is up, down, or sideways. Of the $406,613 the portfolio would add on top of the original $10,000, $255,067 would come from capital appreciation. That's the share prices going up over time. The other $151,546 would come from dividend reinvestment. Okay, quick context on what reinvestment means. When the dividends are paid out, instead of taking the cash, John uses those dividends to buy more shares of the same fund. Those new shares pay their own dividends, which buy more shares, which pay more dividends. Over 30 years, that snowball gets enormous. And that's why almost 37% of John's projected growth in this portfolio would come from dividends compounding on themselves. That's not a small number. That's nearly 4 out of every $10 of growth being generated by the income side of the portfolio. So that's the version built to pay John, a projected $416,613 in the account, $2,048 a month. But that's only one way to build it. And John knows there's another version of him watching this, a version that doesn't care about a monthly check, a version that just wants the biggest possible account at the end. So what happens when John takes those exact same three funds and weights them in the opposite direction? The weights flip almost completely. 70% now goes into FNCMX, the growth fund. 20% goes into FDVV, and only 10% stays in FTIHX. The reasoning shifts. FNCMX gets 70% because its 17.45% appreciation is the highest of the three by a wide margin, and this portfolio rides that growth as hard as possible. FDVV drops to 20% because in a growth-tilted portfolio, dividends aren't the priority. It's just enough to keep some income in the picture without slowing the account down. And FTIHX drops to 10%. International diversification still matters, but at this weight, it's a hedge, not a core position. So with these new weightings, the growth-tilted portfolio runs at a 1.15% blended yield, an 8.71% blended dividend growth rate, with 14.67% annual appreciation. And in this portfolio, that 14.67% is what will do almost all the work. So if the goal is a bigger account, this is what it looks like. After year one, the portfolio would be worth $11,582, almost identical to the dividend version. After 10 years, projections show it growing to $42,454. The gap is starting to open. After 20 years, $173,989, and by year 30, the portfolio is projected to reach $699,558. Here's where this portfolio is obviously different. Of the $689,558 the portfolio would add on top of the original $10,000, $675,422 would come from capital appreciation, while only $14,136 would come from dividend reinvestment. That means almost 98% of John's projected growth in this portfolio would come from share prices going up, not dividends, not reinvestment, just appreciation. And there's a reason for that. When the funds in this portfolio don't pay much in dividends, there's nothing to reinvest. The whole engine becomes share price growth, which is bigger, but it's a different kind of money. It's money on paper, not money in your pocket, which is exactly what shows up in the monthly income number. By year 30, the growth-tilted portfolio is projected to pay $98 a month. For the entire year, that's $1,179 in dividend income. That's the trade. Bigger account, smaller check. So now, both portfolios are sitting next to each other. Same three funds in both. Same $10,000 going in, 30 years on the clock. The dividend-tilted portfolio is projected to reach $416,613 in the account, paying $2,048 a month. The growth-tilted portfolio is projected to climb to $699,558 in the account, paying $98 a month. The bigger account pays 21 times less than the smaller one. Now, some viewers are doing the math right now and thinking, hold on, $699,558 with a 4% safe withdrawal is $27,982 a year. Well, that's $2,332 a month. That actually beats the dividend portfolio's $2,048. So isn't the growth portfolio still the better income play? I'll answer that in a minute, but quick context here. The 4% rule is a guideline that says you can safely pull about 4% of your portfolio out each year in retirement without running out of money. It's the standard rule of thumb for living off your investments. And on paper, that math works, but here's what changes in practice. With the dividend portfolio, John doesn't sell anything. The $2,048 a month would come from dividends being paid out. The account itself stays whole. The shares stay invested. The dividends keep paying him forever. With the growth portfolio, every withdrawal eats into the account. He's selling shares to pay himself. And if the market drops the year he retires, he's selling shares at a loss to live on. That's called sequence of returns risk, and it's the single biggest reason retirees with bigger accounts can still run out of money. Neither portfolio is wrong. They're two different bets on what John wants his money to do. $10,000 put into dividend stocks. What it pays you that first month tells you almost nothing about where this actually ends up, and that gap is the whole story. So is this even worth doing, or is passive income just a game for people already rich? Today, I'm building a real dividend portfolio, 10 stocks, $10,000 split evenly across all of them. I'll walk you through every stock I picked, how I pressure tested each dividend to make sure it actually holds up, and exactly what this thing pays you month after month. And by the end, I'll show you how this same $10,000 is projected to grow into over $200,000. Quick heads up, today's sponsor, Simply Wall Street, is the actual tool I used to build this and check every dividend, so I'll be showing you how it works as we go. Okay, so before you buy anything, you have to change how you look at investing. The normal way people do this is to buy a stock and then just watch the price. Up, down, up, down. It's stressful, and honestly, for what we're doing here, it's the wrong game. With dividend stocks, the question isn't how much the stock price goes up, It's how much the stock pays you for holding it. You're getting paid to own the thing. That's it. That's the whole idea. And there's one move that turns a small income into a big one. You reinvest every dividend. Every single dividend that lands automatically buys you more shares. Those new shares pay their own dividends, which buy even more shares. It starts tiny, a few bucks here and there, but that's the engine. Give it enough time, and it does the heavy lifting for you. But an income's only worth something if it actually keeps showing up every year, no cuts. So before a single stock went into this portfolio, I ran all 10 through one test. Here's the mistake almost everybody makes with dividend stocks. They find one paying some massive yield, 8%, 9%, and they think they've stumbled onto free money. But most of the time, that big fat yield is a warning label. It usually means the company's in trouble and that dividend is one rough quarter away from getting cut. So how do you tell a safe dividend from a trap? Well, you check. And this is where Simply Wall Street actually earned its spot in this video. Let me show you two stocks because between them, they tell the whole story. First one, Verizon. It pays around 6.5%. 6.5% is a big yield. Now, by the rule I just gave you, your gut should be screaming, well, that's a trap. 6.5% is a big yield. So let's not guess, let's actually check it. Simply Wall Street runs 6 different safety checks on a dividend. Is it a strong yield? Is it stable? Is it growing? Is it covered by the company's earnings? Is it covered by their actual cash? Verizon passes all 6. 6 out of 6. Green straight down the line. The yield is real. The company earns way more than enough to pay it, and it's been paid and raised for years. So, that 6.5% everyone's too scared to touch, turns out it's one of the safest payments in the entire portfolio. That right there is the difference between checking and just guessing. Second stock, Exxon. And this one's the opposite problem. Okay, here's Exxon. And Exxon's more interesting because it's not all green. Pull it up, and you can see how Simply Wall Street points something out right away. The dividend isn't fully covered by the company's free cash flow. And on its own, that sounds like a problem. But this is the part people skip. That flag is a starting point, not a verdict. Investigating further, if you look right there on the same page, Simply Wall Street also shows you the other side of it. The dividend is comfortably covered by earnings, 68 cents on the dollar. And the track record? Exxon has raised this dividend 43 years straight. 43. Through oil crashes, through 2020, through every mess the energy market has ever thrown at it. A company doesn't pull that off by accident. So that cash flow flag isn't a dividend about to break, it's a company spending heavy money drilling for the next decade. 2 completely different things. And the balance sheet backs it up. So look at what just happened. One stock had a scary number that was completely safe, and the other had a scary warning that didn't mean what it looked like. None of this is complicated. And thanks to Simply Wall Street, you can read the whole picture instead of just half of it. And I did that with all 10 dividend stocks for our portfolio. Here's the lineup that made the cut. First, I built it in 3 layers. Layer 1 is the boring, bulletproof stuff, the companies that pay you whether the economy's booming or falling apart. Procter & Gamble, the company behind half the things in your bathroom, has raised its dividend 70 years straight. PepsiCo, 54 years, then 2 utilities, NextEra and Black Hills. And Black Hills is wild, honestly. It's raised its dividend 56 years in a row and almost nobody has ever heard of it. These 4 are the anchors. Layer 2 is the blue chip muscle. Exxon, who you already met, Lowe's, which rides basically every home renovation in America, Lockheed Martin. And I love this one for a dividend portfolio because Lockheed Martin pretty much gets paid by the US government in any economy, war, or peace. Plus Johnson & Johnson, 63 years of raises, about as steady as a company gets. Then there's layer 3, the growth kickers. Goldman Sachs pays a smaller yield, but it's been hiking that dividend 18% a year. That's enormous. There's also Verizon, our 6% payer, doing the heavy lifting on income as well. Put it all together and you've got 10 companies across 8 different industries, every single one of them paying you to hold it. Okay, so here we go, 10 stocks, $1,000 each. Let's actually build the portfolio and see what it pays. Building it takes about 2 minutes in Simply Wall Street. And you've got a couple of ways in. You can link your broker and pull all your trades over automatically, or just upload them yourself. For this video, I opened the Portfolio tab, hit New Portfolio, and added each stock manually as a buy. Procter & Gamble, PepsiCo, and the rest. Check this out. All right, so I've already gone ahead and built the full thing out, all 10, $1,000 into each. And the second it's done, it tells you exactly where this portfolio stands, as well as what it pays you now and in the coming months. And here's the whole thing live. Now you'll see the values moved a little since I built it. Up a bit today, up a bit on the week. That's a plus. But the day-to-day wiggles aren't the point of a portfolio like this one. This is the point. Down in the corner, estimated dividends, $322 a year. That's this $10,000 portfolio paying you about $26, $27 a month just for holding it. And it's already got it marked as a solid income portfolio. We'll get into exactly how solid in a minute. But let's be honest about that number first. $27 on $10,000? That's a phone bill. If you came to this video for a get-rich-quick number, obviously that ain't it. And I'm not going to sit here and pretend it is. But $27 a month is the seed, not the tree. And what it grows into is the whole reason you're here. By the end, I'll show you what that $27 a month reinvested turns into, a $200,000 portfolio. It's a number a lot of people won't believe off a $10,000 start, so stick around, that's still coming. But first, is this a real portfolio or just 10 stocks I threw in a pile and called a plan? Simply Wall Street answers that in about 5 seconds. This is the part I actually love. Go to the Analysis tab, and Simply Wall Street takes all 10 stocks and grades the whole portfolio as one thing. Start over in the Dividends tab, and it scores the quality of every dividend you own, showing you where your income actually comes from. About 2/3 of your income comes from the highest quality, safest payers it tracks, and the riskiest bucket? 0%. That's what happens when you run every stock through these safety checks first. The junk never makes it in. Now, back over to the Analysis tab. It stacks your dividend up against the whole U.S. market. Your portfolio yields 3.2%, and the market average is 4.2. And normally you'd think, well, okay, I'm behind here. But think about what's dragging that market number up. It's all the junk, the 9-10% yield traps, the companies about to cut. That average is fat because it's stuffed with dividends that aren't safe. Ours is a little lower on purpose. We threw out all the fat. And here's what you get for it. These companies are raising their payouts almost 8% a year and only paying about 62% of their earnings to do it. So there's plenty of room to keep raising. This income isn't stretched, it's got slack. Same tab, the valuation. The portfolio's sitting at 10 grand, but on a cash flow basis, most of these companies are undervalued right now. Simply Wall Street values what you own closer to $15,500, meaning the whole portfolio is almost 35% undervalued. So you're buying roughly $1 of value for 65 cents, a 35% discount. That's nice. And last one, right below that, diversification. 10 stocks across 8 sectors, none of them running the show. Staples, utilities, energy, healthcare, defense, telecom, all balanced out around 10% each. So if one corner of the economy takes a hit, the whole thing doesn't go down with it. And everything I just did there, the quality score, the valuation, the whole breakdown, you can run all of it with your own stocks, your own portfolio. And honestly, it's barely scratching the surface of everything Simply Wall Street does. So here's what I'll do. I'm dropping the link to this exact portfolio down in the description. You can open it up and see everything we just went through, live, moving in real time. And if you sign up using that same link, you'll get 30% off plus an extended 14-day trial, no credit card required. So go ahead, pull it up, poke around, and get the discounted price for your own portfolio. Now, let's look at what this portfolio is projected to pay month by month. Most of these companies pay quarterly, every 3 months, not every month, but they pay in different months, so it comes in waves. And Simply Wall Street lays the whole thing out on a calendar for you. Watch this. Here's August. Kind of a quiet month. Verizon pays you $16, Lowe's and P&G a few more. So the estimated dividend for this portfolio in August is around $30. September, everything hits. Black Hills, J&J, Exxon, NextEra, Lockheed, Goldman, Pepsi. 7 different companies pay you in the same month. All of that is estimated to be about $52. So no, it's not the same every month. Some months trickle, some months flood. And you can see all of it coming, the exact days, the exact amounts, mapped out months ahead. You're never guessing. And here's the part that matters most. This income doesn't sit still, it climbs. The companies just keep raising on their own. Which brings us to the real question. Leave this thing completely alone for 30 years. Where does it end up? Well, here's what the projections show. After year 1, it would sit at around $11,000. By year 10, it would grow to about $26,500. By year 20, it would reach roughly $72,500. The snowball starts to roll around here. The dividends reinvested around this time are buying serious amounts of new stock every single year. And by year 30, this $10,000 portfolio is projected to be worth over $200,000. And the income? Remember that $27 a month we started with? By year 30, this portfolio would be paying you around $636 every month. That's more than $7,500 a year just landing in your account from 10 grand. That's what time does. You think you're buying a growth ETF. You're actually buying a bet. And depending on which one you pick, that bet pays $12.5 million on $100,000 over 30 years, or $49 million. Same money, same time, different bet. In this video, John takes $100,000 and runs it through 3 of the most popular growth ETFs in the world: QQQ, VGT, and SCHG. Same money in each. 3 things we compare them on: what they cost, what they bet on, and how hard each one is betting. And in the end, I'll show you and John which one of these would have turned that $100,000 into nearly $49 million, and which one would have left him almost $37 million behind. Okay, so the first thing John pulls up is the cheapest part of the comparison, the fees. Every ETF charges what's called an expense ratio. It's the slice of John's money the fund keeps every year just for running it. SCHG charges 0.04%, VGT charges 0.09%, QQQ charges 0.18%. Those numbers look small. They look like rounding errors. So John does what most people don't. He turns them into actual dollars. On $100,000 invested, here's what each one costs every year. SCHG takes $40, VGT takes $90, QQQ takes $180. Now the gap is real. SCHG and VGT are basically background noise, but QQQ, that's $180 a year. 4.5 times more than SCHG every year on the same starting amount. And here's the thing, that money doesn't disappear, it goes somewhere. In SCHG, $40 leaves John's account every year and goes into Schwab's pocket. In QQQ, it's $180, and that money lands in Invesco's pocket. So SCHG gets a $140 head start every year. Over 30 years, that gap matters more than it looks, but not in the way most people assume. So if fees were everything, this video would be over right here. So why isn't it? Because the fee only tells you how much each fund costs. It doesn't tell you what it actually owns. And that's where these three stop looking like the same investment. Now John pulls up what each fund actually holds, and this is where they stop being three flavors of the same thing. Every ETF on this list tracks an index. That just means the fund is built to mirror a specific list of companies. The index decides what's in, the fund follows. VGT tracks the MSCI US Information Technology Index. That is pure tech, software, hardware, semiconductors, IT services. That's the whole universe. If a company isn't tech, it's not in VGT. QQQ tracks the NASDAQ 100 Index. That's the 100 biggest non-financial companies on the NASDAQ. Tech-heavy, sure, but broader. Costco is in there. Pepsi is in there. Amgen, the biotech company, is in there. None of those are tech, but all of them are in QQQ. SCHG tracks the Dow Jones US Large Cap Growth Index. That one's the broadest of the three. Large cap growth across every sector, tech, consumer, healthcare, financials, anything growing. So look at what's actually happening here. Three growth ETFs, three completely different bets on what growth even means. VGT is betting tech wins. QQQ is betting NASDAQ-listed innovation wins, which is broader than tech but narrower than the market. Meanwhile, SCHG is betting large cap growth wins no matter where it shows up. Three different theses, and John has to figure out which one he believes. So now we know what each fund believes, we know what each one costs. The thing we don't know yet is how much each one is willing to put behind the bet. And in the end, I'll show you how, with that decision, which ETF would turn $100,000 into nearly $49 million, and which one would have left John almost $37 million behind. Look, most growth ETF comparisons skip this part. They tell you what each fund holds, but they don't tell you how hard each one is pressing the bet. Here's what that means. Every ETF has a list of holdings, but not every holding is the same size. The biggest companies in the fund get the most money, and the size of the biggest holdings tells you how concentrated the fund actually is. So John pulls up the top 10 holdings in each fund, and here's the first thing he notices. They're all chasing the same names: Nvidia, Apple, Microsoft. Top three positions in every single one of these ETFs. The question isn't what they hold, it's how much of each fund is sitting on those names. In VGT, the top 10 holdings make up about 59% of the entire fund. In SCHG, it's almost the same, 58%. And in QQQ, it's lower, around 47%. So at the top 10 level, VGT and SCHG look pretty similar. That's not where the real gap shows up. Here's where it does. Look at just the top three holdings: Nvidia, Apple, and Microsoft. The same three companies in every fund. In VGT, those three names alone make up nearly 45% of the entire fund. In SCHG, they're about 30%. In QQQ, they're closer to 22%. Stay with me because this is the part that actually matters. If John puts $100,000 into VGT, about $45,000 of that is riding on just three companies. The same three names in SCHG only get about $30,000 of his money. In QQQ, those three companies are getting around $22,000. Same names, same companies, wildly different exposure. And here's what that does. It amplifies. If Nvidia has a great year, VGT pulls more return out of Nvidia than the others do, because more of VGT's money is sitting on Nvidia in the first place. If Nvidia had a bad year, VGT loses harder. Then there's the second layer, and this one's not even close. VGT is 99.6% technology. Almost the entire fund is one sector. QQQ is about 51% technology, with the rest spread across communication, consumer, healthcare. SCHG is 45% technology, with the broadest spread of the three. So concentration isn't good or bad here, it's a lever, and the lever cuts both ways. VGT is the bet that says, I know which companies are going to win, and I'm putting more of my money on them. SCHG is the opposite bet. It says, I don't know which ones win, so I'll spread it out across more sectors. QQQ is the hedge in the middle. Concentration is conviction, and these three funds are all betting at very different levels of conviction. That's the framework. 3 funds, 3 bets, 3 different levels of conviction. The question now is whether the bet actually pays. And the receipts are in the appreciation rate. Here's where the concentration math actually shows up. Every ETF has an average annual appreciation rate. That's just how much the share price has grown per year on average. It's the engine that drives long-term return. Over the last decade, VGT has averaged 22.89% annual appreciation. QQQ has averaged 20.01%. SCHG has averaged 17.39%. Those gaps look small on the surface. They're not. VGT didn't outperform by accident. VGT was the most concentrated bet on the companies that actually exploded: Apple, Microsoft, Nvidia, Broadcom. The same names that did the heavy lifting on every tech run of the last 10 years. VGT had more of its money sitting on those names than QQQ or SCHG did. The bet paid. The receipts are in the appreciation rate. SCHG spread the same money across more companies, including ones that didn't explode. The diversification was real. It also cost SCHG a return. There's a dividend story here too, but it's a footnote on a video about growth. QQQ has the highest dividend growth rate of the three at 9.12%, well ahead of VGT at only 5.49% and SCHG at 4.58%. That matters in income-focused videos, not this one. Growth ETFs aren't bought for the dividend. They're bought for what the share price does. And what the share price does is what John is actually buying. Those are the rates. They're what the bets have produced per year. The real question, the one $100,000 actually answers, is what happens when those rates run for 30 years. And here's what the projections show. After the first year, all three funds basically look identical. SCHG is at $117,770, QQQ is at $120,440, VGT is at $123,260. Roughly a $5,000 spread on $100,000. Anyone watching just year one would call this a wash. That's the trap. That's only year one. Skip ahead 9 years and watch what starts happening. 10 years in, the gap is real. SCHG is projected at $506,000, QQQ is at $633,000, and VGT is at $797,000. VGT is now nearly $300,000 ahead of SCHG. The funds aren't the same animal anymore. The concentration mechanism is showing up. 20 years in, here's where they sit. SCHG is at $2.5 million. QQQ is at $3.95 million. VGT is at $6.27 million. VGT is now about 2.5 times SCHG. That 5% appreciation gap John saw earlier, it's now a $3.7 million difference. Same starting amount, same 20 years. Give it 10 more years, and here's where the same $100,000 ends up. SCHG lands at $12.58 million. QQQ doubles that at $24.57 million. And VGT, $49.3 million. That's what 22.89% annual appreciation does when you give it 3 full decades without touching it. Same starting line, same 30 years, and almost a $37 million gap between the smallest finish and the biggest. VGT didn't win because it tracked something different. All 3 are growth ETFs. All 3 hold the same biggest companies. VGT won because it was the most concentrated bet on the companies that actually grew. In short, SCHG was the safer bet. QQQ was the famous bet. VGT was the conviction bet. And that's the trade growth ETFs make. They're not all the same, not even close. The label hides the bet, and the bet is what compounds. $100,000 in the bank pays you $300 a month. The same money in the S&P 500 pays you about $100. The same money in the right 5 REITs would pay over $10,000 to $20,000 a month. In this video, John takes that $100,000 and runs it through 5 of the strongest REITs on the market. 1 pick per category: net lease, cell towers, storage, data centers, and industrial. We'll cover the numbers behind each one, the trade-offs, and the role each REIT plays. Plus, I'll show you one REIT that's projected to pay John over $20,000 every single month in dividend income. And in the end, I'll show you a REIT that turns the same $100,000 into a $6 million portfolio that pays over $11,000 in monthly dividend income. So before we get into the picks, quick groundwork, because a lot of people hear REIT and assume it's just another stock. It's not. A REIT, Real Estate Investment Trust, is a company that owns income-producing property: warehouses, cell towers, storage units, data centers, apartment buildings. And here's the part most people miss. By law, REITs have to pay out at least 90% of their taxable income to shareholders. That's the rule that makes them exist. That's why REIT dividends look the way they do. The S&P 500 right now yields about 1%. REITs across the board pay anywhere from 3 to 6%. Some go higher. Now, a quick note before the numbers. These projections assume John's holding everything inside a Roth IRA, so the dividends and growth compound without tax drag. Outside of a Roth, REIT dividends are mostly taxed as ordinary income, and the long-term math looks different. Okay, that's the setup. Let's get to the rules John used to narrow this down. 5 filters for choosing these REITs. That's it. The REITs must have a current dividend yield above 1.5%. It has to actually pay. A track record of growing the dividend over the last 5 years, or a clear reason why it hasn't. It must be the dominant name in its sector. It has to have institutional ownership close to or above 80%, meaning the big money has already done the work, and we can only have 1 REIT per category, no overlap. The last one matters. A portfolio of 5 storage REITs isn't diversified. It's 5 bets on the same thing. John's picking 1 warehouse name, 1 tower name, 1 storage name, 1 data center name, and 1 retail name. 5 different jobs, 5 different sectors. And here's how they line up. The first REIT on John's list is Realty Income, ticker symbol O. People in the dividend world call it the monthly dividend company because that's exactly what it does. It pays every single month. What does Realty Income actually own? Over 15,000 commercial properties leased out to companies that have to keep their doors open no matter what's happening in the economy. Stores like Dollar General, Walmart, 7-Eleven, Walgreens, convenience stores, pharmacies, grocery chains. Boring businesses on long contracts, usually 10 to 20 years, where the tenant pays not just the rent, but the property taxes, insurance, and maintenance on top. That's what triple net lease means. The tenant covers everything. Realty Income just collects the check. And here's the part that says everything about the company. They've raised the dividend 133 times since going public in 1994, including 113 consecutive quarterly increases. The numbers? Right now, O is paying a 5.23% dividend yield. The dividend's grown at a 5-year compound rate of 3.53%, and the share price has been creeping up at just 0.75% a year, which tells you exactly what this REIT is and isn't. It's not a growth stock. It's a paycheck. So what does that paycheck look like over 30 years? After year 1, John's $100,000 in realty income would grow to $105,980. After 10 years, $190,986. After 20 years, $434,048. And by year 30, projections show that $100,000 valued at $1.23 million. That's a $1.13 million gain on a single one-time investment. Of that $1.13 million, only $84,000 comes from share price growth. The other $1.05 million comes from reinvested dividends. Almost all of the growth is the dividend doing the work. By year 30, the annual dividends are projected to be $127,295, or $10,608 a month. One REIT, one job, done well. Next on the list is American Tower, ticker symbol AMT. And if you've never heard of it, that's kind of the point. Most people haven't. But every time you make a phone call, send a text, open Instagram, or stream anything on a 4G or 5G signal, the signal probably passes through one of their towers. American Tower owns nearly 150,000 communication sites globally as of the end of 2025. Cell towers, broadcast towers, rooftop antennas, distributed antenna systems inside stadiums and office buildings. They lease that infrastructure out to carriers like Verizon, AT&T, and T-Mobile. And here's the thing about cell tower leases. They're 5 to 10 years long with built-in annual price increases baked into the contract. So the rent goes up every year automatically. The carriers can't really leave either because moving equipment to a new tower is expensive and disruptive. Once a carrier's on a tower, they tend to stay for decades. That's why AMT has been able to grow its dividends so consistently. The current yield sits at 3.89%, lower than O, but the 5-year dividend growth rate is 8%, and the share price has been appreciating at an average of 5.73% a year. So you're getting less income today, but a much bigger growth engine running under the surface. Run those numbers across 30 years, and the picture shifts. After year 1, John's $100,000 in AMT would grow to $109,620. After 10 years, $260,367. After 20 years, $747,799. And by year 30, that $100,000 is projected to be valued at $2.43 million, almost double what realty income delivered. Of that $2.33 million in gains, about $1.1 million comes from the share price growing, and $1.22 million comes from reinvested dividends, way more balanced than O. The stock is doing real work alongside the dividend. And by year 30, the monthly check is projected at $13,317, so a higher monthly income too, even with a lower starting yield. That's the thing a lot of investors miss. Higher yield doesn't always mean more money in the long run. Growth matters just as much as the starting number. 2 REITs down, 3 to go. Next, I'll show you a REIT that pays over $20,000 in monthly dividend income. And in the end, I'll show you a REIT that turns John's $100,000 into more than $6 million, paying over $11,000 in dividend income every month. The third REIT on John's list looks weak on paper. 0 consecutive years of dividend growth. That's the stat most people see, and that's where most people stop looking. Here's what they miss. In 2022, Public Storage sold its 41% stake in a company called PS Business Parks to Blackstone for $2.3 billion. And instead of keeping that cash, They handed it straight back to shareholders as a one-time $13.15 special dividend. Then, in early 2023, they raised the regular quarterly dividend by 50% from $2 a quarter to $3, and they've held it flat there ever since. So when you see 0 consecutive years of growth, what you're really looking at is a REIT that raised hard and then held the line, a pause after a big jump. Now, what does Public Storage actually do? Well, they're the biggest self-storage REIT in the world, over 3,000 facilities across the U.S. And here's the part that's almost counterintuitive. Self-storage tends to hold up well in downturns when other real estate sectors struggle. That's because when people downsize, they need somewhere to put their stuff. When they move in with family or change jobs, they store. Self-storage is one of the only real estate sectors where economic stress actually helps the business. The numbers right now? PSA is paying a 3.93% current yield. The 5-year dividend growth rate is 8.45%, and the share price has appreciated at an average of 4.84% per year. Solid across the board, nothing flashy. But here's where it gets interesting. After 1 year, John's $100,000 in PSA would grow to $108,770. After 10 years, $247,211. After 20 years, $730,551. And by year 30, that $100,000 would be valued at $2.77 million. The monthly dividend by year 30 is projected at $21,899. $21,899 a month from one REIT and one-time $100,000 investment. That's more than some American households earn in a year, every single month, for the rest of John's life. Out of the $2.67 million in total growth, about $950,000 comes from share price growth. The other $1.72 million comes from reinvested dividends. So if PSA is paying nearly $22,000 a month, what's the next REIT even supposed to do? That's where it gets interesting. So this is going to look like a step backward, but it isn't. This is Equinix, ticker symbol EQIX. And while every other REIT on this list owns physical, traditional real estate, Equinix owns something most people don't even think of as real estate: data centers. Equinix runs over 280 data centers across 77 markets. These are massive, climate-controlled, fortress-grade facilities full of servers, the physical buildings that make the internet possible. Every time you send a Slack message, stream a movie, query an AI model, run a cloud app, or load a website, that data is routing through someone's data center, often Equinix's. And the demand isn't slowing down. AI alone is driving a level of data center build-out the industry hasn't seen in decades. Some estimates put data center capacity at doubling every 4 to 5 years just to keep up. So why is this REIT lower on the income list than the storage one? Because Equinix is built differently. The current yield is at 1.91%, the lowest on the entire list, but the 5-year dividend growth rate is 12.24%, and the share price has been climbing at an average of 11.77% a year. That's the engine. Most of the return isn't coming from the dividend at all. It's coming from the stock itself. So here's what that does over 30 years. After 1 year, John's $100,000 in EQIX would grow to $113,680. After 10 years, $361,745. After 20 years, $1.32 million. And by year 30, that same $100,000 is projected to be valued at $4.85 million. That's almost double what PSA built, bigger than AMT, bigger than O. But the monthly dividend by year 30, it's just $7,767. Still a solid income, but less than every other REIT on this list, except Realty Income. That's the trade. Because of how the math worked out, of the $4.75 million in total gains, over $4 million came from share price appreciation. Only about $730,000 came from reinvested dividends. The wealth came from the stock, not the dividend. So you've got two different jobs being done by two different REITs. PSA built a $2.77 million account paying almost $22,000 a month. EQIX built a $4.85 million account paying $7,700 a month. Both are right, both are valid, they're just doing different things with the same $100,000. Which brings us to the last one. One REIT on this list builds the biggest account. One REIT pays the biggest check. The last REIT does both at the same time. This is Prologis, ticker symbol PLD, the largest industrial REIT in the world. Here's what they own. Every time you click Buy Now on Amazon, every time a package shows up at your door, every time a Walmart shelf gets restocked, the product was sitting in a warehouse somewhere before it got to you. Prologis owns more of those warehouses than any other company on the planet, about 1.3 billion square feet across roughly 5,900 buildings in 20 countries. Their tenants are basically the entire global supply chain: Amazon, FedEx, UPS, Walmart, DHL, Home Depot. If a major company moves goods at scale, they probably lease space from Prologis. And here's why that matters. Industrial real estate has been one of the strongest real estate sectors of the last decade. E-commerce growth, supply chain reshoring, and just-in-time inventory pressure have all driven warehouse demand to record levels. The leases are long, the tenants are massive, the cash flow is durable. The current yield is 2.93%. The 5-year dividend growth rate is 11.59%, and the share price has appreciated at an average of 11.93% a year. Here's what the projections look like for Prologis. After 1 year, John's $100,000 in Prologis would grow to $114,860. After 10 years, $398,114. After 20 years, $1.57 million. And by year 30, that $100,000 is projected to be valued at $6.15 million. That's the biggest account on this entire list, by over $1.3 million. And the monthly check by year 30 is projected at $11,881, more than EQIX, less than PSA, but more than triple what most retirees pull from any traditional investment. Of the $6.05 million in total growth, about $4.93 million comes from share price growth and $1.12 million comes from reinvested dividends. This is what makes Prologis different from every other REIT we covered. PSA wins on income. EQIX wins on account growth. Prologis is the only REIT on the list that doesn't have to choose. If you've been watching this thinking, well, I want both, I don't want to choose between income and wealth, well, that is exactly where Prologis lands. What happens when you take $200,000 and spread it across the 5 best Fidelity index funds? John's asking himself that right now. And the answer comes down to one thing: how he builds it. Build it one way, and John gets paid more than $6,000 a month for life. Build it another way, same $200,000, same 5 funds, and the account grows into almost $13 million. In this video, John takes that $200,000 and spreads it across 5 Fidelity index funds, built to cover everything from America's biggest companies to the fastest growing corners of the world. Then he builds 2 completely different portfolios out of those same 5. One tilted to pay him, one tilted to grow. And by the end, you'll see how one version pays John over $6,200 a month for life, and the other turns that same $200,000 into a $12.8 million account. So here's where John starts. He's gone through just about every index fund that Fidelity offers, and he keeps landing on the same 5. There's a reason for that. Every portfolio worth building has a few jobs that need to be filled. Number 1, something to anchor it. 2, something to grow it fast. 3, something reaching for the companies that aren't big yet. 4, something paying real income. And 5, something betting on the parts of the world that everyone's written off. 5 jobs, and these 5 funds handle them. Quick thing before we get into them, in case you're newer to this, an index fund is just a basket of stocks that follows a set rule. Nobody's sitting there picking winners and losers. The fund owns whatever's in the index that it tracks, and that's it. That's why these things cost almost nothing to own, and why they tend to work so well if you just leave them alone over the long term. All right, the 5 funds. John starts with the one that holds everything together, the boring one, FXAIX, the Fidelity 500 Index Fund. This is the anchor. It tracks the S&P 500, which is basically the 500 biggest companies in America all in one fund. When you hear someone say, well, the market was up today, this is basically what they mean. The names inside are exactly who you'd guess: Nvidia, Apple, Microsoft, Amazon, Meta, and it leans heavy on tech, more than a third of the whole fund. John picks this one first and doesn't think twice about it. There's nothing to debate here. If you're building anything at all, this is the floor you build it on. One quick note before we get to the numbers, because we're about to use the word dividend a lot. A dividend is just a slice of a company's profits that get paid back to you for owning the stock, usually every 3 months. Own more shares? Get a bigger check. That's the whole idea. On the numbers, FXAIX runs a 1.06% dividend yield, a 6.84% dividend growth rate, and a 13.54% annual share price appreciation. And that appreciation number is the steady engine the rest of the portfolio gets measured against. So the core gives John all 500 of those companies at their normal size, every one of them treated the same. But a handful of those names have been pulling most of the weight lately. And the next fund John picks is built to lean right into them. FNCMX, the Fidelity Nasdaq Composite Index Fund. If FXAIX is the anchor, this one is the engine. It tracks the Nasdaq Composite, which is around 3,000 companies, and it's packed with tech. One quick bit of context first, because this one trips people up. The Nasdaq isn't a company, and it isn't really a fund either. It's a stock exchange, a place where stocks get bought and sold. It just happens to be where most of the big tech names list themselves, so any fund tracking it ends up tilted hard toward tech. Now look at what's actually inside. Some top names you just saw in FXAIX: Nvidia, Apple, Microsoft, Amazon, Alphabet. But the weights are a completely different story. In this fund, Nvidia alone is more than 11%. The top 10 holdings make up nearly 59% of the entire thing. So you're not really getting 3,000 companies spread out evenly, you're getting a heavy bet on a few tech giant names with a long tail trailing behind them. John adds this one as his growth play, and the reason is basically one number. FNCMX comes in at a 0.47% dividend yield, a 6.91% dividend growth rate, and a 17.95% annual share price appreciation. That 17.95% is the highest of any fund in this entire video. That's the upside. Just one thing to know, remember that tech-heavy concentration cuts both ways. When big tech is running, the fund flies. When big tech takes a hit, this is the one that feels it first and feels it the hardest. FXAIX and FNCMX have one thing in common though. They're both built out of giants, companies that already made it. Which leaves a pretty obvious gap. Where's the growth that hasn't happened yet? FSSNX, the Fidelity Small Cap Index Fund. And to introduce it, let me just read you a few of its top holdings. Bloom Energy, Coeur Mining, Fabrinet. If you've never heard of a single one of those, good. That's kind of the whole point of this fund. It tracks the Russell 2000, which is about 2,000 small American companies, the ones that are too small to make it into the S&P 500. And unlike FNCMX, nothing in here is a big bet. The top 10 holdings add up to under 6% of the fund. No single company really moves the needle. It's 2,000 little shots on goal, spread thin. The idea behind it is simple. Every giant inside FXAIX was a tiny company once as well. This is John's bet that a few of these names turn into the giants of the next 30 years. Run the numbers on FSSNX and you get a 0.89% dividend yield, a 7.44% dividend growth rate, and a 9.6% annual share price appreciation. Now, I've got to be straight with you about this one because the numbers don't tell the story you'd expect. Small caps are supposed to be the high-risk, high-reward slice, the rocket fuel. But look at that 9.6% appreciation. It's the lowest we've seen so far, lower than both big U.S. funds. Small companies have actually trailed the giants for years now. So why even hold this one at all? Well, not because the track record wins, because obviously it doesn't. John holds it because it's the one corner that the other four funds can't reach. The small stuff before it's big. That's not a sure thing, it's a bet, and he's making it on purpose. And that is the whole American side of the portfolio. The biggest companies, a concentrated bet on the best of them, and a flyer on the smallest ones. But here's the problem with stopping there. Every dollar is still riding on one single country, and no country leads forever. The US has had a brutal decade before, where it went nowhere for years, while the rest of the world kept moving. So putting a piece of your money outside America isn't betting against it. It's making sure your whole plan doesn't depend on one country winning every single decade. For this, John goes with FSPSX, the Fidelity International Index Fund. And this is the one that genuinely surprised him, because the highest paying fund of the five isn't an American fund at all. It's this one. FSPSX tracks something called the MSCI EAFE, which is a fancy way of saying developed countries outside of the US. Think Japan, the UK, Germany, Switzerland, Australia. Established economies, big, stable companies. The kind of names you sort of half recognize. Nestle, Roche, AstraZeneca, HSBC, plus ASML, a Dutch company most people have never even heard of that builds the only machines on Earth advanced enough to print a modern computer chip. They don't make the chips, they make the machine that makes them possible. FSPSX does two jobs in this portfolio. The first one is income, and we'll get to exactly how much in just a minute. The second is insurance. If America hits a rough patch, this is the part of the portfolio that doesn't go down with it because it isn't tied to the US at all. Here's where FSPSX earns its spot. A 5.8% dividend yield, a 6.85% dividend growth rate, and a 7% annual share price appreciation. That dividend yield at 5.8% is more than triple the next highest fund in the lineup. But sit with those numbers for a second, because they pull in two directions. FSPSX pays the most of any fund here, while it grows the account the slowest of any fund here. Developed International has lagged the US for well over a decade. So you've got the best income and the weakest growth living inside the same fund. Hold that thought, because it's the exact tension the back half of this video runs on. So, Developed International hands John the income and the stability. But those same developed economies are the slow-growing part of the world, which leaves one last piece, the part of the world that's still on its way up. FPADX, the Fidelity Emerging Markets Index Fund. And this one's a flat-out contradiction. It's been one of the worst-performing corners of the market for about 10 years running, and it has the fastest-growing dividend of all 5 funds in this portfolio. Both of those are true at the exact same time. Emerging markets just means the economies that are still growing into their full size. Not the US, not Europe, places like Taiwan, South Korea, China, India. About 80% of this fund sits in Asia, and it's top-heavy in a way that's worth seeing for yourself. Taiwan Semiconductor is the company that takes machines like ASML's and actually manufactures the chips. Most of the world's advanced chips come out of their factories, and it's more than 14% of the whole fund on its own. One company on one island carrying a seventh of everything in here. After that, it's Samsung, SK Hynix, Tencent, Alibaba, all of them giants, none of them American. It's worth noticing, actually, Nvidia anchored the American funds, ASML showed up over in Europe, and now Taiwan Semiconductor here in Asia. Chip makers are propping up every single corner of this portfolio on every continent. The whole modern market kind of runs on them now. John's reason for holding this one is the dividend growth. The numbers on FPADX land at a 1.91% dividend yield, an 11.01% dividend growth rate, and a 7.71% annual share price appreciation. That 11.01% dividend growth is the highest in the entire portfolio. So that's all 5. An anchor, an engine, a wild card, an income payer, and a long shot. 5 funds, 5 jobs, done. But here's the part most people get completely backwards. Picking good funds, that's the easy part. Anyone can do it. The decision that actually changes John's life is how much of each one he buys. Because these exact 5 funds can be built 2 completely different ways. Lean the weights in one direction, and this portfolio pays John every single month. Lean them the other way, and it grows into something close to twice the size. Same $200,000, same 5 funds. The weighting is the entire strategy. Next, I'll walk you through the dividend-tilted portfolio, the version that pays John $6,273 every single month for life. And in the end, you'll see how the growth-tilted version takes that same $200,000 and turns it into a $12.86 million portfolio. So let's build the first one, the version designed to pay him. This is the dividend-tilted portfolio. Here's how the $200,000 splits up. The biggest slice, 35%, goes to FSPSX, the International Fund. That's $70,000. It's the biggest piece because it's the one writing the checks. That 5.8% yield is the cash actually landing in John's account. Next, 20% into FPADX, the Emerging Markets Fund, $40,000. This is the long shot, but remember, it's also got the fastest growing dividend of the 5. In an income portfolio, that matters a lot. It's the piece that grows the paycheck over time. Then 20% into FXAIX, the S&P 500, another $40,000. That's the quality anchor, keeping the whole thing grounded in America's biggest companies. 15% goes to FNCMX, the growth engine, $30,000. Even in an income build, John wants some real growth in here so the account doesn't just stall out. And the last 10%, $20,000, goes into FSSNX, the small cap wildcard, the smallest slice because in a portfolio built to pay you, the long shots stay small. Now here's something that flips how this looks. Add up the American funds, FXAIX, FNCMX, and FSNX, and they come out to 45% of the portfolio. The 2 international funds are the other 55%. So this isn't John turning his back on America, it's him letting the higher paying side of the world take the lead while almost half the money stays home. Put those 5 weights together, and the dividend-tilted portfolio comes out to a 2.78% yield, a 7.75% dividend growth rate, and a 10.35% annual appreciation. So that's the build. Here's what it's projected to actually do. After the first year, projections show the $200,000 growing to $226,272. Nothing wild yet. Give it 10 years, and it's projected to reach $668,839. By year 20, projections have it at $2,125,315, and by year 30, the dividend-tilted portfolio is projected to reach $6,492,396. By year 30, this portfolio is projected to pay John $75,282 a year in dividends. That works out to $6,273 a month, every month for the rest of his life. And here's what makes that different from just selling off stock to live on. He doesn't touch the account to get it. The $6,273 is the dividends being paid out on their own. The shares stay invested. The account stays whole and keeps right on growing. The money just shows up. Of the roughly $6.29 million this portfolio is projected to add on top of the original $200,000, about $5.45 million would come from share prices rising over time. The other $839,000 or so would come from dividends being reinvested along the way. That word reinvested is doing a lot of work, so quick explanation. Every time a dividend gets paid, instead of pocketing the cash, John uses it to automatically buy a few more shares. Those new shares then pay their own dividends, which buy more shares, which pay more dividends. Stretch that loop over 30 years, and it turns into a snowball. So that's the version built to pay John $6.49 million in the account and $6,273 landing every month without him selling a thing. But that's only one way to build it. And John knows there's another version of him watching this, a version that doesn't care about the monthly check, a version that just wants the biggest possible account at the end. So what happens when he takes those exact same 5 funds and weights them in the opposite direction? Same 5 funds, brand new weights, and they look almost nothing alike. Half the entire portfolio now, 50%, $100,000, goes to FNCMX, the growth engine. That 17.95% appreciation was the highest of the group, and this build leans on it as hard as it possibly can. 25% goes to FXAIX, the S&P 500, $50,000. Still the anchor, just a bigger one this time, adding more steady large cap growth. 10% goes into FSSNX, the small cap wildcard, $20,000. Same as before, the long shot for some extra upside. 10% goes into FPADX, emerging markets, another $20,000. The bet is still on the table, just sized small. And finally, FSPSX, the international fund that was the whole star of the income build, well, it drops all the way down to 5%, $10,000. At this weight, it isn't paying the bills anymore. It's just a little insurance against the U.S. having a bad stretch. Notice what happened to the 2 international funds. In the income build, they were 55% of everything. Here, they're only 15%. They basically swapped seats with the American growth names. This portfolio is now about 85% American, and almost all of it is built to grow, not to pay. When you average those 5 together, the growth-tilted portfolio runs at a 1.07% yield, a 7.35% dividend growth rate, and a 14.44% annual appreciation. That appreciation number is what's about to do almost all the work. So if the goal is the biggest possible number at the end, this is what that's projected to look like. After year 1, it's projected at $231,022. By year 10, projections showed the growth build reaching $825,205, already pulling ahead. By year 20, $3,285,871. The gap just keeps widening every decade faster than the one before. And by year 30, the growth-tilted portfolio is projected to reach $12,862,188, almost $13 million out of that same $200,000. And almost all of that is one single thing: share prices going up. Of the $12.66 million this portfolio is projected to add, about $12.47 million would come from appreciation alone. Only about $197,000 of it would come from dividends. That's close to 98% pure price growth and barely a sliver from income, which shows up exactly where you'd expect it to. By year 30, this portfolio is projected to pay John $14,244 a year. That's $1,187 a month. So, John's now got two portfolios in front of him, and the one that grew almost twice as big is the one that pays him almost nothing. That's the part that doesn't sit right with John at first. The income build ends at $6.49 million. Paying $6,273 a month. The growth build ends at $12.86 million, paying only $1,187 a month. On the dividends alone, the smaller account pays more than 5 times what the bigger one does. But hey, I know some of you are already running a different set of math in your head, because there's another way to pull income out of that big account, and it's called the 4% rule. Quick explanation: the 4% rule is the standard guideline for living off of your investments. The idea is you can pull out about 4% of your portfolio every year in retirement, and the account should last you. So let's apply it. 4% of that $12.86 million growth portfolio is $514,487 a year, which comes to $42,874 a month. That is a fantastic number. It's nearly 7 times the income portfolio's $6,273. So if your goal is the most spendable cash in retirement, the growth build, using the 4% rule, is genuinely hard to beat. That's a real valid way to do this. Now, 4% is just the starting point. If you want to play it safer, a lot of people pull 2 to 3% instead, so the money lasts even if they live to 100. On this account, 3% is still $32,155 a month. Sure, there will be some flex year to year, more in good markets, less after a bad one. Whatever number you'd actually use, you can run it on your own balance. The point is, the big account gives you that flexibility. So if the growth portfolio can pay that much more, why would anyone build the income version instead? Here's the one thing the 4% rule can't get around: selling. That $42,874 a month only exists if John sells off a chunk of his shares every single year. He's slowly drawing the account down to pay himself. Meanwhile, the income portfolio's $6,273 works differently. That's dividends being paid out while every share stays exactly where it is. The account doesn't shrink. In fact, it keeps growing. He never sells a thing. And that difference matters most the moment the market drops. Say it crashes the same year John retires. With the growth portfolio, he'd be selling shares at the bottom just to cover his bills, locking in those losses for good. There's a name for that risk. It's called sequence of returns risk, and it's one of the reasons people retire with huge accounts and still manage to run low. The dividend portfolio doesn't care what the market did this year. The checks just keep coming. So I know what you're asking. Which one actually wins? Both of them. That's the honest answer. The growth portfolio makes John richer, and it can hand him far more cash to live on as long as he's comfortable selling pieces of it and riding out the timing. The income portfolio pays less, but it never asks him to sell, and it never leans on good timing to work. One version is a bigger pile he draws down over time. The other is a check that shows up every month while the whole account just sits there, still growing. That right there is the real decision John's making. Does he want a bigger number that he has to slowly take apart, or a steady paycheck that leaves the entire thing standing? Take $500,000, put it into one ETF, walk away for 5 years. The ETF you picked decides whether you come back to a bigger account, a steady paycheck, or a number that looks great and changes nothing. 3 different lives, one starting amount. In this video, John takes $500,000 and runs it through 5 different ETFs over the same 5-year period, and you'll see exactly what the account looks like at the end of each year and exactly what each ETF pays him along the way. One of these ETFs pays him over $5,000 a month by year 5. Another almost triples his money in the same window. They're not the same ETF. And in the end, I'll show you how to combine all 5 ETFs into one portfolio that gets you the best of both worlds. The place John starts is in the same place almost everyone does, the S&P 500, or by its ticker, VOO. It's the name everyone gave him when he asked where to put $500,000, so this is where he starts. VOO is the Vanguard S&P 500 ETF. It tracks the 500 biggest companies in the U.S., names like Apple, Microsoft, Amazon. The bigger the company, the more weight it gets inside the fund. There's no clever strategy, no stock picking. The fund just owns the U.S. market and holds it. The expense ratio is almost nothing, about 3 cents on every $100 invested. On John's $500,000, that works out to roughly $150 a year in fees. That means almost all of his money stays at work instead of going to Vanguard. This is the ETF you buy when you want one decision made once that you don't have to think about again and again. You're not betting on a sector, you're not chasing a trend, you're just owning the U.S. economy and trusting that over time it goes up. 3 numbers explain how VOO actually pays back. The dividend yield sits at 1.09%. Dividend growth has averaged about 6.07%, and share price appreciation has run at roughly 13.03%. And that last number is where almost all of the work gets done. One thing to lock in before we run the numbers, the projections assume that every dividend VOO pays out goes straight back into buying more shares. That's why the account compounds faster than share price alone would suggest. So here's what that does to John's $500,000 over the next 5 years. By the end of year 1, projections put the account at $570,600. Year 2 takes it to $650,736. Year 3 pushes it to $741,667. Year 4 climbs to $844,817, and by year 5, the balance would be sitting at $961,797. Almost double in 5 years without picking a single stock, without timing a single trade, without doing anything but holding it. John sees that number land and understands why everyone told him to buy this one, but then he checks the income column. In year 1, dividends come out to $5,450. By year 5, they reach $6,900, about $575 a month. $575 on an account worth nearly $1 million. That's not broken. That's exactly how VOO is built. The fund is designed to grow, not to pay. Almost every dollar VOO earns gets reinvested into share price, which is why the balance climbs the way it does. The dividend was never the point. Paying you is not a huge part of VOO's design. But John didn't come here just to watch the account get bigger. He wanted to know what $500,000 actually does for him. And $575 a month on nearly $1 million isn't a number that changes anything in his life. So if VOO grows the account but barely pays him, where does the income piece actually come from? And the answer to that isn't another U.S. fund. Turns out you have to leave the U.S. to find it. Most of the world's biggest companies aren't in the U.S., they're in Europe, in Japan, in emerging markets, places John's never bought a single share of because nobody told him to. That's where VXUS comes in. VXUS is the Vanguard Total International Stock ETF. It owns over 8,500 companies, basically every public company outside the United States, all wrapped into one fund. No country bets, no sector picks, just the rest of the world in one ticker. Fees here run about 5 cents per $100 invested. On John's $500,000, that's around $250 a year. A bit higher than VOO, but still small enough that fees aren't the conversation. The reason people add VXUS isn't speed, it's that international companies tend to pay more of their profits out as dividends instead of reinvesting them. So the income side starts behaving differently the moment the money lands. VXUS runs a 2.77% dividend yield, almost 3 times what VOO pays, with dividend growth around 6.14% and share price appreciation closer to 5.86%. Less acceleration on the account, more cash showing up along the way. Here's what 5 years of VXUS does to $500,000. Year 1 lands at $543,150. By year 2, the account reaches $590,066. Year 3 brings it to $641,080. Year 4 moves it up to $696,555. And by year 5, the balance ends at $756,885. That ending number is over $200,000 lower than where VOO finished. And that's usually where people stop the comparison. But listen, VXUS isn't done. Look at this. John checks the income column, and this time it's a completely different story. Year 1 pays $13,850. By year 5, the dividend climbs to $19,512, about $1,626 a month. $1,626 every month on the same $500,000 that paid him only $575 a month inside VOO. That's almost 3 times the income from a smaller account. Not because VXUS is doing something clever here, but because international companies just hand more of their earnings back to shareholders year after year by design. John starts to see the trade clearly now. VOO grew the account faster, but barely paid him. VXUS pays him real money, but it grows the account slower. Neither one is wrong, they're just answering different questions. So now there's a third question worth asking. What if the income didn't have to come from giving up growth? What if there was a fund built to do both? And that's the question SCHD was built to answer. SCHD is the Schwab U.S. Dividend Equity ETF. But it's not just a basket of dividend-paying stocks, it's screened. To get into SCHD, a company has to have been paying dividends for at least 10 years, has to have the cash flow to keep paying them, and has to actually be growing those dividends over time. Skip any of those tests, and the company doesn't make the cut. That's why SCHD only holds about 100 companies instead of the 500 or 8,500 we just looked at. It's not trying to own the market. It's trying to own the part of the market that pays you well and grow what it pays. The fee on SCHD runs about 6 cents per $100. On John's $500,000, that's about $300 a year in fees, cheap enough that the screening doesn't cost him anything that matters. And the screen shows up clearly when you look at the metrics. SCHD pays a 3.4% dividend yield, meaningfully higher than VOO and slightly higher than VXUS. Dividend growth runs at about 10.43%, almost double what either of the first two funds delivered. And share price appreciation comes in around 8.87%, slower than VOO, but better than VXUS. SCHD is what income and growth looks like in numbers. So here's what it does to John's $500,000 across the same 5 years. Year 1 brings the account to $561,350. Year 2 carries it up to $630,525. Year 3 pushes it through to $708,565. Year 4 hits $796,651, and by year 5, SCHD lands at $896,130. That's almost catching VOO on growth. The gap between them at year 5 is around $65,000 on a fund that is also paying real income. And the income is where SCHD pulls clear of both VOO and VXUS. First year, $17,000. Fifth year, $28,816, about $2,401 a month. $2,400 every month on an account that's also growing at almost the speed of the S&P 500. This is the first fund that doesn't make John give something up. The growth is there, the income is there, and the dividend itself keeps growing year after year by design. For a second, this looks like John's answer, the fund that does both well enough with no obvious cost. But there's a ceiling. SCHD pays well, but it doesn't pay a lot. And John hasn't seen what happens yet when an ETF stops trying to balance two things and just goes all in on one of them. So, 3 ETFs down, 2 left. Next, I'll show you what happens when an ETF only focuses on income, then an ETF that only focuses on maximum return. And in the end, I'll show you how John combines all 5 into one portfolio, which gets him the best of both. But first, let's look at the ETF that's built to pay, and that is JEPI. JEPI is short for JP Morgan Equity Premium Income ETF, and it's built on a completely different idea than anything we've looked at so far. JEPI doesn't just hold stocks and wait for dividends, it holds large U.S. companies, names like Microsoft, Visa, MasterCard, and on top of that, it sells options on those holdings every month. Each option JEPI sells brings in cash from another investor who's paying for the right to buy those shares at a set price. That cash gets pooled with regular dividends and paid out to JEPI shareholders. So John isn't just collecting dividends, he's collecting dividends plus monthly option income. That extra layer is why JEPI's fee is higher, about 35 cents on every $100 invested. On John's $500,000, that's around $1,750 a year. Not cheap. But this isn't a fund trying to be cheap, it's a fund trying to pay. And trying to pay shows up in JEPI's metrics in a way nothing else does. The dividend yield sits at 8.33%, more than double SCHD, more than 7 times VOO. Dividend growth is slower at 2.79%, and share price appreciation is the lowest we've seen at 1.45%. Income clearly gets the priority here. Everything else takes a back seat. And here's how that plays out on John's $500,000 across 5 years. Year 1 lifts the account to $548,900. Year 2 moves up to $603,195. Year 3 clears $663,543. Year 4 reaches $730,690. And by year 5, the balance lands at $805,480. The account grew, but not the way VOO grew it. Not even the way SCHD grew it. The income, on the other hand, well, that's the headline. Year 1 pays John $41,650. By year 5, that number reaches $64,195 a year, about $5,350 a month. $5,350 every month, more than a lot of full-time jobs pay. So JEPI isn't competing with the others on growth. It's not trying to. The whole fund is built around one job, turning $500,000 into essentially a paycheck. And by year 5, that paycheck becomes the size of a very generous paycheck. But there's a cost, and the projections make it visible. JEPI's account ended at $805,480. VOO's ended at $961,797. That's roughly $156,000 of growth John gave up to get the income he's holding now. So now the question flips. If picking JEPI means giving up that much growth, what happens if John does the opposite? That is VGT. VGT is the Vanguard Information Technology Index Fund. It owns U.S. tech almost exclusively. Over 99% of the fund is in technology. We're talking companies like Apple, Microsoft, Nvidia, Broadcom, Oracle. There's software, hardware, semiconductors, the whole stack. There's zero diversification across sectors here. There's no income strategy. The fund is built to ride one thing: the long arc of U.S. technology, and let everything else take care of itself. VGT's fee is about 9 cents per $100 invested. On John's $500,000, that's around $450 a year, slightly higher than VOO, but the fee was never the cost. The cost here is concentration. When tech wins, this fund wins big, but when tech struggles, John feels every bit of it. You can see the bet spelled out in the metrics. VGT's dividend yield is 0.37%, almost nothing. Dividend growth runs at about 5.49%, but from a base so small it barely registers. Where VGT separates itself from everything else is share price appreciation, which has averaged around 22.39%. That single number is doing the work that VOO's 13%, SCHD's 8.87%, and JEPI's 1.45% can't touch, not even close. So here's what happens when John puts $500,000 into VGT for 5 years. Year 1 jumps the account to $613,800. Year 2 surges to $753,117. Year 3 runs up to $923,664. Year 4 crosses into seven-figure territory at $1,132,434. By year 5, the balance would be sitting at $1,387,984, almost triple from $500,000 to nearly $1.4 million in 5 years. The growth story here is so big it requires no explanation. The number makes every other fund in this video look slow. As for the income, well, it's a footnote. In year 1, the dividend is $1,850. By year 5, it's $1,998, or about $167 a month, on an account worth nearly $1.4 million. So the account almost tripled, but the income barely moved. By year 5, John's $1.4 million pays him less per month than VOO did on $500,000. So you might be thinking, well, something is broken here. but it's not in the fund. The fund is doing exactly what it was built to do. Tech companies don't pay dividends. They reinvest into research, into hiring, into the next product cycle. So as the share price climbs, the dividend stays flat and the yield collapses against itself. The bigger VGT gets, the less it pays. By design. Okay, now John has the full picture. VOO grew the account, but barely paid him. VXUS paid more, but grew slower. SCHD did both in moderation. JEPI paid him a paycheck, but barely moved. While VGT almost tripled the account, but paid him nothing. 5 ETFs, 5 different versions of what $500,000 can do over 5 years. And unfortunately, not a single one of them on its own gives John everything he wanted. Which leads us to the question he probably should have started with. What if John didn't have to pick just one? So John doesn't pick just one. He takes the $500,000 and splits it across all 5 ETFs with one rule guiding him. Every fund gets the weight that matches what it's actually good at. So $150,000, about 30% of the portfolio, goes into JEPI. JEPI is the income engine, so it gets one of the biggest slices. This is the fund that makes the monthly paycheck real. Another $150,000, the same 30%, goes into SCHD. JEPI pays the income now, SCHD grows it, both at scale, working together. $100,000, 20%, goes into VXUS. International dividends pay differently than U.S. dividends, and VXUS keeps the income stream from depending entirely on what U.S. companies decide to do. $50,000, 10%, goes into VOO. The S&P 500 is the steady backbone. It just compounds in the background while the dividend funds do the heavy lifting on income. And the final $50,000, the last 10%, goes into VGT. This is the growth engine, small enough not to swing the whole portfolio, but large enough to put real tech upside under everything else. No fund is doing the entire job. Each one is doing the part it's actually built for. When you blend the metrics together at those weights, the combined portfolio comes out at a 4.22% dividend yield. Dividend growth around 6.35% and share price appreciation of roughly 7.81%. Numbers that don't look extreme in any one direction. Now run that mix on John's $500,000 across the same 5 years. Year 1 puts the account at $560,145. Year 2 builds it to $627,180. Year 3 lifts it to $701,856. Year 4 carries it to $785,004. And by year 5, the balance would be sitting at $877,540. And the income runs alongside it the whole way. Year 1 pays $21,095. Year 5 reaches $31,227, about $2,602 a month. $2,600 a month, while the account grows to $877,540. Compare that to where each ETF ended on its own. VGT ended higher on the account, $1.4 million. JEPI ended higher on the income at $5,350 a month. The combined portfolio doesn't beat either of them on its own metric, but it doesn't lose to them either. John's account still grew by 75% over 5 years. His monthly income still beats what most people earn from a part-time job, and no single ETF, no single sector, no single strategy is carrying the whole plan on its back. When tech runs hot, VGT pulls. When U.S. dividend stocks rally, SCHD pulls. When option income stays strong, JEPI does the heavy lifting. When international markets recover, VXUS pulls. And underneath all of it, VOO does what VOO has always done. The portfolio isn't trying to win at any one race. It's trying to never lose all of them at the same time. John's got $1 million in one fund, SCHD. The fund nobody really gets excited about. Safe, reliable, the one that's supposed to just sit there and behave. So the question John is sitting with is kind of an odd fit for a fund like this. How long before that million becomes two? In this video, John invests that million into SCHD. I'll show you how fast that happens and introduce you to a simple rule, the rule of 72, that lets you work it out for yourself with any investment amount. In the end, I'll show you the exact year SCHD doubles that million into two and how SCHD can match the most popular fund on the planet while still paying over $60,000 a year in dividend income. So what is SCHD exactly? Well, SCHD holds just over 100 big American companies, names you'd know, like Coca-Cola, Chevron, Verizon, Texas Instruments. And it picks them for one boring reason. Each has a long record of paying dividends and raising those dividends. So here's the part that trips people up. Most people shopping for a dividend fund chase the biggest yield they can find. The highest number wins, right? Well, not really. A fat yield that never grows is just a number standing still. Picture two funds. One pays you 4% but never raises it. The other starts at 3% but bumps the payout up every year. Give it a few years and that 3% fund is writing you a bigger check every single year than the 4% one. And the gap just keeps growing. The 3% fund kept climbing while the other just sat there. So how does SCHD score on that exactly? Well, look at its dividend grade. Straight A. 14 years of raising the payout every single year. And over the past decade, that dividend's grown about 10.43% a year, against roughly 6% for the average other funds. The rest fills in fast. A 3.22% yield today, share prices growing around 9.23% a year, and an expense ratio of just 0.06%. On $1 million, that fee is $600 a year. It's basically a rounding error. It's also one of the most heavily traded funds out there, so getting in or out is never a problem. And it's not just me calling it solid. The rating on the whole fund comes back a buy. Now, out of all the numbers, that dividend growth rate is the one doing the real work down the road. So if you're wondering where all this is coming from, the grades, the growth history, the ratings, it's all from today's sponsor, Seeking Alpha. And that's just the tip of what they offer. They've got a stock and ETF screener based on whatever you want, and their alpha picks have beaten the S&P 500 by 325%, and over the last year, by 72%. If you want to get all of this, their summer sale is on right now, and if you use my links down in the description or in the pinned comment, you get the best discount out there, 25% off premium. If you want their stock picks as well, the alpha picks and bundle links are right there next to it. So back to John. Here's his starting line. He puts the full million in. Year one, SCHD is projected to pay him $32,200 in dividends, about $2,683 a month landing in his account without him selling a thing. And the account itself would sit at $1,124,500 by the end of that first year, including both the dividends and the capital appreciation. Up $124,500 in 12 months. Not bad for the fund that's supposed to be safe and boring. So how many more years until it's doubled? Turns out you don't need a spreadsheet to get close, you just need one piece of math. Here's the trick. It's called the Rule of 72, and it's the fastest way to figure out how long money takes to double. You take the number 72 and divide it by your yearly return. Whatever you get is roughly how many years it takes to double. That's it. And here's why this matters for you, not just John. It doesn't care how much you start with. $1 million, 50 grand, 500 bucks. The doubling time comes out the same. The only thing that changes is how many zeros are on the end. So if your number isn't $1 million, run the same math on whatever you've actually got, and it still works. Okay, so let's point this at SCHD and John's situation. The share price is projected to grow about 9.23% a year. Run that through the rule, 72 divided by 9.23, and you land at just under 8 years to double. 8 years. And that's the boring answer. That's the answer if you treat SCHD like a regular stock and ignore the dividend that it's paying you and the dividend growth. But John's not ignoring the dividends. He's reinvesting every single one, and that changes the math entirely. So here's what reinvesting actually does. Every dividend SCHD pays, John just buys more shares with it. More shares means a bigger dividend next time. And a bigger dividend buys even more shares. It keeps feeding itself. Then there's a second thing working in John's favor. The companies in the fund keep raising what they pay out. So even the shares John already owns start handing him more each year. The money grows two ways at once. More shares and more from every single share. Now, here's where most people get SCHD wrong. They file the dividend under, well, that's a nice little bonus, pocket money on the side. The real action they figure is the share price, but it's actually the other way around. Reinvested, that dividend is the part doing the work in the background, buying more of the fund every quarter while John sits there doing nothing. He's not adding a cent of his own money. The fund is paying to grow itself. That's the engine the Rule of 72 left out. 8 years was the share price grinding away alone. Feed the dividends back in, and that timeline gets a lot shorter. How much shorter? Well, I'll show you in a couple of minutes. And in the end, you'll see how SCHD can match the most popular fund on the planet while still paying over $60,000 a year in dividends. Before the finish, one more thing to keep your eye on: the check. Most people watch the balance, the big number climbing. John watches something else, what the fund actually pays him while it grows. And this is where SCHD splits off from a pure growth fund. A growth fund would hand John a bigger and bigger pile, sure, but the income coming off of it barely budges. You'd be sitting on a fortune on paper, with a dividend that still couldn't cover a car payment. SCHD runs both at the same time. The account grows and the paycheck grows on the same clock. Year one, it's paying him $2,683 a month. The real question is what that number looks like by the year it doubles John's investment. Let's run it out. We know year one, the account would sit at $1,124,500. Watch what happens from there. By year two, it's projected to be around $1,264,935. Year three, $1,423,403. By year four, it would reach $1,602,286, and by year five, the account would sit at $1,804,292, knocking on the double door. And then, year six, $2,032,497. The million is now $2 million in just under 6 years. That's about the time it takes a kid to go from kindergarten through 5th grade. The fund that was supposed to just sit there doubles John's money, and he never lifts a finger. Now look at what it's paying him. That check that started at $2,683 a month, by year 6, it's projected at $5,139. It nearly doubles as well, right alongside the account, exactly like a dividend growth fund is supposed to. And here's the proof of the second engine. Across those 6 years, the dividends John reinvested add up to $273,845 fed back into the fund. Here's why that number is the whole story. Strip the dividends out, and the share price on its own only gets John to about $1.76 million by year 6. Close, but not doubled. That last $250,000, the dividends he reinvested and never touched, is what carries him over the line. The share price does most of the lifting. The dividends do the part that actually matters, which is impressive. But I can already hear the objection because it's the one that comes up every single time. Why not just buy VOO? Fair question. VOO is the S&P 500. 500 of the biggest companies in America all in one fund, and it's even cheaper than SCHD at 0.03%. It's probably the single most popular investment on the planet. Ask about anyone where to park your money, and odds are they say VOO. So let's hand VOO the same million and run the exact same race. And I'm not going to dance around it. VOO wins the race. It crosses 2 million a little past year 5. Call it 5.5 years, a few months ahead of SCHD. It even ends year 6 a touch bigger. That's just what the S&P does. It's a growth machine. And SCHD was never trying to beat it at that. So basically, if the only question is which one doubles faster, VOO takes it, clean. Except that was never really the question. Look at what each one pays John along the way. By year 6, VOO is handing John about $14,078 a year, roughly $1,173 a month. SCHD, that same year, $61,669, over $5,000 a month. For every dollar of income VOO pays John, SCHD pays him 4.5. And the gap isn't holding steady, it's widening. Year 1, it's about 3-to-1. By year 6, it's 4.4-to-1 and still climbing because SCHD raises its payout almost twice as fast as VOO does. But here's the thing about everything you just watched. John started with $1 million. If this helped you think about money more clearly, stick with the channel. Everything here is built to make long-term investing feel simpler and more realistic.